But this bull market has been battle-tested.
The fundamentals have still remained very healthy.
Wall Street's figured it out. It's a buying opportunity.
The market is highly skeptical that the ceasefire is real.
It feels like we're on the same kind of off-ramp here. That's pretty good for the market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning and welcome to Bloomberg Surveillance. I'm Annmarie Hordern. Markets are waiting for Islamabad as delegations from Iran and the United States prepare for talks in Pakistan. The ceasefire remains fragile, but the president is frustrated by the lack of traffic in the Strait of Hormuz. On Truth Social, Trump said Iran is doing a very poor job. This is not the agreement we have, and it comes as a key license from the Treasury Department allowing the purchase of Russian oil set to expire this evening at midnight. And we'll see the war's impact on inflation data later this morning. Danny Berger, thank you for joining me. John and Lisa are off. So really, this is going to be the first check when it comes to data about how the war has impacted the economy.
It's true, and maybe that finally wakes the market up. Maybe it won't. Stocks are less than 1% away from where we started this whole conflict. But it is the first big piece of data that will capture the energy price ramping through March. Expectations, Annmarie, 0.9%. That would be the highest print since 2022. How much of that is reflected in corporate earnings looking forward? How much of that is reflected in markets for now? It is at least an equity market that has decided that the off-ramp to peace, that's the important thing, not achieving peace itself.
But at the moment, the rhetoric does not match the facts on the ground. Ships are not going through the Strait of Hormuz like normal, and clearly the president is frustrated with that. There are going to be these negotiations, but you have to ask, what is going to be success for either side?
It seems like mixed messaging from this president. On the one hand, he says that negotiations are going well, and what the Iranians say behind closed doors is different than what they say to the public. But then you get what you pointed to, the president expressing his frustration on Truth Social and taking issue with this idea of a toll. I wonder where that leaves us through the Strait of Hormuz, because many people have pointed to the toll as being the obvious solution to this, that maybe the United States participates in it. If the president's not okay with that, what does it look like to reopen the strait?
Yeah, and I actually asked him about this a few weeks ago, and he said, yeah, I know they're doing it a little bit. This is what Khamenei said yesterday in a statement. We'll definitely bring the management of the Strait of Hormuz to a new stage. It's the same regime, different management. And for Iran right now, that is their only piece of leverage in these negotiations.
Right. Why would you let that go? And again, it gets me back to the market pricing. Even if you do have some tankers going through the Strait of Hormuz, you're going to get a toll charged. It seems like the only way to get through is to have bilateral negotiations with the Iranians. That still seems like it leaves us in a higher place for oil. Maybe not 100, maybe 80, but that still makes a difference for this market.
Yeah, at some point, will the futures market catch up to where actually the physical market is trading? This morning, we do have equity markets, futures relatively flat. This comes after, as Danny said, markets for the past 7 days have been on a tear, going higher. Euro dollar this morning, 117. 10-year yield, 430, trading within range. And then, of course, we're all going to be focused on crude oil as we head into these very high-stakes talks tomorrow in Pakistan. New York crude, WTI right now, 98.71. Coming up on the program, Michael Purves of Tallbacken Capital Advisors with stocks on a 7-day winning streak. Maha, Yahya of the Carnegie Endowment for International Peace as President Trump demands the reopening of the Strait of Hormuz, and Krishna Guha of Evercore ISI on what today's inflation print means for the Federal Reserve. We begin this hour with our top story. President Trump demanding Iran reopen the Strait of Hormuz ahead of the peace talks this weekend. Bloomberg's Jumana Bersetchi joins us now from Dubai. Jumana, busy weekend for you ahead. Set the table for us for these talks in Islamabad.
Yeah, well, President Trump is saying that he's confident that these talks actually will be successful. He also said in an interview with NBC that the Iranians tend to be more reasonable when they're not in the public domain. So let's see whether this actually translates. And the big challenge here is turning what has been actually an ongoing ceasefire the last couple of days, very little activity reported overnight. So the ceasefire is still in place, into a more permanent cessation of hostilities, and whether the two sides can actually bridge a lot of the daylight that still exists between their relative positions. Now, what I will say is it's the early afternoon over here in the region, and there's still no confirmation yet that the Iranian delegation has landed in Islamabad. So we still don't know if they're actually there. This may change in the course of the next few hours, but it's important, of course, not only because they need to be represented, but in the case that the whole talks and all of these efforts get torpedoed by the events in Lebanon. And this has been extremely noteworthy over the last 24 hours or so, because the Iranian sides are saying that there is a possibility they don't end up participating in the talks unless a ceasefire is established in Lebanon. And this comes after a day of very heavy bombardment. Wednesday, Israel's heaviest day of airstrikes in Beirut and other parts of Lebanon as well. The death toll was very high. And on the back of that, you did see a lot of international community backlash. As a consequence of that, it seems as though the White House did put pressure on the Israeli Prime Minister. And so by the end of the day, the Israeli Prime Minister Benjamin Netanyahu did say that they were going to start directly negotiating with the Lebanese government, not with Hezbollah, but with the Lebanese government. So you could say that there are two tracks opening up here, but so long as Iran wants to bring the Lebanon portfolio into the bigger portfolio, I think is going to really overhang the potential outcome of negotiations that we get this weekend. In addition to, of course, the new issue that you and Danny were just talking about, which is Iran wanting to maintain sovereignty still over the Strait of Hormuz. If you look at how many vessels have passed through since the ceasefire, it's minimal, probably 10 in total since Tuesday. Effectively, they're still monitoring who and what vessels can get through this waterway, an outcome that is not acceptable for President Trump, as he suggested on his Truth Social post yesterday, and clearly not acceptable for Gulf states as well. So, expectations are low, but at least there is some optimism about where we could get to, and that the very worst case scenario of an even more destructive military escalation in the region has been avoided.
Jumana, thank you so much. And I look forward to your reporting this weekend. Of course, Bloomberg's Jumana Bersecci leading our coverage out of the Middle East. Here's the view on Wall Street this morning. Michael Purves of Tallbacken writing, "The real thing hovering over the market is that we will still don't know the return on investment from the massive AI spend from the big tech companies. This is a bigger issue than the Iran war." Michael joins us now. Michael, why is that a bigger issue than what is happening right now in terms of a pretty massive conflict that is whipsawing markets every single day in the Middle East?
Well, let's step back for a second and just think about what's happened with the S&P 500 over the last 3 months. Year to date, as you were just pointing out, the market's basically flat. If you look at that 8%, basically forward earnings are up 8% and PEs are down 8%. That's a very healthy sort of backdrop to consider the market there. And I think what's been happening with Iran and oil prices, and I'm not dismissing it, I think it creates all sorts of lingering issues for the economy and for various parts of the markets. But I think it's really going to be, it's almost in some ways more of a problem for the bond market than it is for the equity market. If earnings are able to continue to grow at the index level, of course, every sectors are different, and single stocks are different. That is sort of overarching. I think getting back to your question about the AI, I mean, look, if you look at price earnings multiples relative to their growth for the big, the Mag 6 or the big tech sector, those have been really compressed. But the problem is that effectively the PEs that these stocks are going to be have been rated on are going to be in I think, lower range until this massive CapEx spend, which is just simply historic, is able to demonstrate what the actual returns on that spending are. And I don't think we're going to get answers to that anytime soon. But my setup right now is that we have a problem with the big tech spend demonstrating sustainable high margin economics on the one hand, but the overall economy and the overall earnings profile for the broader index should be okay here coming through this.
Michael, I do just wonder, though, if we have a premium of something around $30 priced into oil, to what extent is that currently reflected in earnings expectations? Because that's, at the end of the day, a tax on every transportation, packaging, retail, consumer-oriented company. If we're paying 22 times forward earnings, is that an honest mark?
Well, I think it's a little bit more like 20 times right now. We do have a little bit of a discount by the standards of the last couple of years. Again, I'm just looking at Bloomberg consensus estimates, not my own there. But yeah, look, I think the question about higher oil prices being a tax on the consumer is a very real one. And I don't want to take too much comfort in the fact that a year ago we had this incremental tax through tariffs, and yet companies and many parts of the consumer were able to grind through that, just fine. I think it's helpful to look at that, but it's also, you don't want to be complacent in just saying, oh, there are, this is just going to be a replay and everything's going to be fine in Q2 and Q3 and Q4. I do think that there's going to be certain parts of the economy that are going to be hurt by this. And there's going to be certain parts of the economy, the energy sector, for example, that will have have at least a near-term benefit from these higher oil prices there. I think this story really one sort of cross-asset consideration here is that if you look at what happened to implied correlations across stocks in the S&P 500 through this move, they really did not surge. They surged a lot higher during other sort of volatility events there. And that to me is a bit of a tell that this story is really going to play out in a very sort of nuanced and diffuse way, as opposed to sort of, earnings are categorically bad and equities are going to be dangerous, so we have to exit the equity asset class. The VIX really has not surged, and it has not surged because these correlations cross-stock correlations have been so low.
I should correct myself. The Bloomberg forward PE ratio is 21, so we fall somewhere in the middle between you and I, Michael. So if that's the overall cross-asset picture, you started out by saying this is a bigger problem for bonds than it is for equities. And we have heard calls, PIMCO and the like, saying maybe we should be buying bonds at this point because the ultimate impact will be weakening growth and a Fed that cuts, therefore bonds are attractive. Why do you think that this Treasury market is more challenged than that?
Well, in theory, the PIMCO argument, I think, is absolutely right. Like, we should be buying bonds at these elevated yields there. And if anything, the growth picture is negative and the oil shock is transitory and the supply shock there. But I think the broader picture here has been one, and this is, I think, sort of nuanced but very important, is that the move higher in yield since February has all been really been driven by a repricing of Fed policy here. And so what that, to me, I think you need to get the back end yields back down to where they were 5 weeks ago. I think you really need to see that Fed policy pivot back to where it was in February. Longer term break-even inflation rates have not really moved up in any significant way. It's really about the Fed policy. So how do we get Fed to pivot back to where it was in February? You either need some really bad economic data over the next couple of months, and or with a presumed new chairman coming in, you need him, presuming Warsh wants a lot of cuts as soon as possible, you're going to need him to convince his colleagues at the Fed to do that. And I think that's going to be sort of a tall ask to expect that in the near future.
It's gotten much harder, especially as oil prices are higher amidst this war. Michael, thank you so much for joining us this morning. Michael Purves of Tallbacken Capital Advisors. We want to get you an update now on stories elsewhere this morning we're watching. Here's your Bloomberg brief. The U.S. and Iran heading into high-level peace talks in Pakistan tomorrow. Ahead of the talks, President Trump warning Iran against charging fees on tankers going through the Strait of Hormuz. Israeli Prime Minister Benjamin Netanyahu agrees to have direct negotiations with Lebanon. Netanyahu says there is currently no ceasefire between the two nations and vowed to keep attacking the Iranian-backed Hezbollah. The Wall Street Journal reporting the talks will be preparatory at the ambassador level. And the Senate Banking Committee is no longer planning to hold a confirmation hearing for Kevin Warsh next week. The hearing to confirm Warsh as Federal Reserve Chair was scheduled for Thursday. Punchbowl's reporting Warsh has not submitted all of the necessary paperwork just yet. That's your Bloomberg brief. Coming up on the program, all eyes on the Strait of Hormuz.
Should Iran be able to charge a toll for the Strait of Hormuz? They're charging some vessels to go through.
Oh, yeah. Well, should they be able to? I mean, they shouldn't be able to, but they're doing it a little bit.
Maha Yahya of the Carnegie Endowment for International Peace is coming up next. You're watching Bloomberg Surveillance. Good morning. Good morning. Welcome to Bloomberg Surveillance. Markets this morning relatively flat. Of course, the markets are a little bit angsty on this Friday. The week doesn't end today. Of course, there's going to be these incredibly high stakes discussions in Islamabad over the weekend, led by Vice President J.D. Vance with the Iranians. And clearly it comes at a time when they're holding on to this fragile truce, but we do not see the uptick from ships moving in and out of the Strait of Hormuz, which is why oil is going to be in focus. NYMEX crude right there, you see it, $98.89, up 1% after a volatile week, with oil moving all around when it comes to the headlines coming out of the White House. Under surveillance this morning, all eyes on the Strait of Hormuz.
Should Iran be able to charge a toll for the Strait of Hormuz? They're charging some vessels to go through.
Oh, yeah. Well, should they be able to? I mean, they shouldn't be able to. But they're doing it a little bit. I don't know. Look, their capability is a lot less than it was 2 weeks ago. And with every week and every day, frankly, it gets less and less. All I can tell you is they're begging to make a deal. So let's see what happens.
Here's the latest. President Trump demanding Iran reopen the Strait of Hormuz, warning Tehran against charging fees for passage. Bloomberg's Tyler Kendall joins us now from Washington. Tyler, very good morning to you. So what does success look like for the U.S. this weekend?
Yeah, hey, Annmarie, good morning. Well, at this point, we know that the Strait of Hormuz and reopening it is going to be the main point of success as President Trump ramps up these threats just 1 day away from these direct talks. The White House, though, maintains that the diplomatic efforts, though, are on track. But at least publicly, both sides appear very far apart when it comes to some of these key tenets, not just of the ceasefire, but of what could be in a longer-term agreement. Now, in these pair of posts, President Trump last night saying that Iran is doing a, quote, very poor job at reopening the strait because, as you've mentioned, at this point, we've seen very few ships ultimately transit through. Now, President Trump has previously floated this idea that both the U.S. and Iran could charge tolls when it comes to the strait, though the White House press secretary Caroline Leavitt did say earlier this week that that's not a definitively accepted policy position by the U.S. And in part, that's because tolls in the strait are actually raising legal questions under international law, as Bloomberg News has previously reported that the starting price by Iran appears to be $1 per barrel, likely paid in digital currencies by these ships that are transiting through. And I'll point you to a new analysis released by the Wall Street Journal earlier today that finds that it's going to be Gulf states in particular who are paying the brunt of these tolls if they stay in place. But whether they stay in place or not, Annmarie, this is just underscoring how a longer-term deal could really be tenuous, considering Iran, we know one of their top demands is that they want sovereignty over the waterway. Annmarie, at this point, that is a non-starter for the U.S. As you well know, there appears to be these big differences, including what the future of Iran's nuclear capabilities are going to look like. But again, officials say it's all going to come down to this weekend, setting the tone for the 2 weeks ahead.
Tyler, thank you so much. Bloomberg's Tyler Kendall in Washington. Joining us now is Maha Yahya, Director of the Middle East Center at the Carnegie Endowment for International Peace. Maha, the fact that they're meeting, is that basically the success of this weekend?
In short, yes, the fact that they're meeting, but I don't think any of us are holding our breath, so to speak. It's very clear that the maximum Iran is willing to offer does not meet the minimum of what President Trump is requiring. They're speaking at each other, not with each other. And a lot of the news that has come out over the last few days just points to that, between President Trump saying he threw the 10-point plan in the garbage, the Iranians saying the ceasefire includes Lebanon, then, I mean, we've seen a lot of confusion, strategic confusion, I would say. So we'll wait and see what happens, but I don't see these talks at least leading somewhere. It's positive. It gives everyone a breather for now. And we have to wait and see where this goes.
Do you think it's a breather to more escalation?
It could be. It could be. I mean, it's very clear that the IRGC, their demands of the Iranian regime, control over the Strait of Hormuz, as your reporter said, their nuclear capacity, negotiating over their partners and proxies across the region. I mean, these are non-starters for the United States, let alone Israel, which is a major player in this. The deal may be between the U.S. and Iran. These are the two negotiating parties, at least up front. But the real partner in this is Israel. And already we've seen rumbles of discontent because, from what we understand, President Trump announced this ceasefire without real consultation with his partner, Benjamin Netanyahu. So it is a breather. We may see escalation again, but it is a breather for now.
And just on that note, Maha, one of the big areas, if not the biggest area of concern with this ceasefire on the side of the Iranians was Israel continuing to attack Lebanon. We learned yesterday that they're going to be holding direct talks. Wall Street Journal reporting this morning that they're preparatory talks. It's happening at the ambassador level. How big of a factor is this going to be heading into the weekend as a separate thing that could derail any hopes of a ceasefire?
Look, the talks themselves, I think, are important in the sense they really break a decades-old taboo. In the past, when Israel and Lebanon have negotiated, they've always negotiated via third parties, never face-to-face. So this is the first time that you have direct talks between a Lebanese representative and an Israeli representative. Will these lead anywhere? Not at the moment, no. It's very difficult to negotiate with someone that's bombing you. On one hand, the Lebanese government itself is trapped between a rock and a hard place because the decision to stop any kind of military activity rests elsewhere, not with the government. You have to bring Iran into the game. And frankly, for Benjamin Netanyahu, he has no interest in stopping the conflict in Lebanon. It's a war that is popular with his own base and with the broader, I mean, according to the polls we're seeing, the war is quite popular. Politically, he promised residents in the north that it's not about stopping the attacks. He wants to completely destroy and dismantle Hezbollah, something he promised in Gaza and hasn't been able to do with Hamas. So it's very difficult to see how they're going to, again, they will not go for a ceasefire. And Hezbollah is saying, we will not, we want a complete ceasefire. Iran is saying the same thing. So it puts everybody in a very murky situation. What we might see is, again, another breather in the sense that the conflict is ongoing in the south. The bombings has not stopped in the south at all. But we may see Lebanon spared another Black Wednesday, what we saw 2 days ago of an entire complete blitz, 100 airstrikes in the space of 10 minutes. It was absolutely terrifying. To this moment, it's more than 300 people killed, thousands injured, and to this moment, it just doesn't make any rhyme and reason beyond terrorizing the country.
Maha, thank you so much for your time this morning and some of your insights from the region. Maha Yahya of the Carnegie Endowment for International Peace. That last point, the fact that the Iranians are making Lebanon and Hezbollah a part of this, says to me, one, Iran is going to continue backing their proxies in the region, but also this is why it's so hard for the White House. This isn't like Liberation Day where Donald Trump holds all the cards. It's not even just the United States and Iran. It's the United States, Iran, Israel, Gulf partners, what's going on in Lebanon. Very challenging.
It's what makes an off-ramp really difficult. And again, it's a market that maybe is overlooking that or is just focusing on the positivity. I saw this one fact from Marco Papic of BCA Research saying that the U.S. is only responsible for about 20% of daily strikes on Iran. The rest are Israel. Israel is a huge player in this.
Yeah, and that's why the president had to call him. If he wanted this ceasefire, he had to call Bibi Netanyahu. Coming up in the program, more on this conversation. Ellen Wald of the Atlantic Council. With crude, diesel, and gasoline prices on the rise ahead of key driving season in the United States. Plus, Christina Aquino will join us with your morning movers. Rising AI demand fueling an optics rally. You're watching Bloomberg Surveillance. Very Very good morning to you. Welcome to Bloomberg Surveillance. I'm Annmarie Hordern. Lisa and John are off today, and I'm joined by Danny Berger this Friday morning with equity futures doing relatively nothing. But of course, we need to remember we have had 7 days of gains, one of the biggest weekly gains for the S&P 500 we have had in over a year. When it comes to what else traders are looking at this morning, of course, we are counting down to the all-important CPI data at 8:30 Eastern. You do have 10-year Treasury yields up about a basis point. 4.30 on the 10-year. There's your board for 2 10s and 30s. And all eyes today and this week going into the weekend is going to, of course, be on oil. We have high-level talks happening in Pakistan. You have Brent crude at $96.45, NYMEX at $98.59. They are 2 different contracts. We should note that when you look at that spread. WTI is on the May contract. Brent is on the June contract. The point of the matter is, though, is that oil is ticking higher because the facts on the ground have not changed. Essentially, the Strait of Hormuz is still closed. And this is going to be a key negotiating leverage the Iranians will use at the table. But of course, the United States, especially off the president's Truth Social post yesterday, they definitely want to see the movement of vessels. So we're 3 hours away from the cash open. Let's get some morning movers with Christine Aquino. Hey, Christine.
Hey, Anne-Marie. All right, let's take a look at optics this morning. Those shares are hot. Lumentum up in pre-market, dragging its peers, Applied Optoelectronics and Coherent along with it. That is because of comments from Lumentum saying that demand from the biggest U.S. companies for its products is actually accelerating. The company said that it is booked solid. It is on track to fulfill its order books through 2028. And CEO Michael Hurlston said that CapEx for the biggest hyperscalers in the U.S. doesn't seem to have any end in sight. And it is, in fact, falling further and further behind in terms of being able to meet that demand. Not exactly a bad problem to have. Let's also take a look at shares of Taiwan Semiconductor, TSMC. That company reported a 35% increase in quarterly revenue, the equivalent of $35 billion. That is, of course, beating projections. Analysts see this as a sign that Middle East tensions hasn't necessarily curbed demand for chips here. TSMC, of course, reporting its full results on April 16. Its shares are up more than 30% this year, actually beating some of its biggest customers, including NVIDIA and Apple. And of course, taking a look at Shake Shack as well this morning, those shares are higher in the pre-market as well. It received an upgrade from Mizuho to outperform from neutral and a price target of $120. Reminder that earlier this month, the company did affirm its guidance for first quarter and full year revenue. And Bloomberg Intelligence saying that its increased ad spending as well as improved execution will help it beat in the first half. Those results are due early in May. Anne-Marie and Danny.
Thanks so much, Christine. I actually love Shake Shack because they have a gluten-free bun.
Are they the only ones? I feel like that has to be rare to have a gluten-free bun.
Them and Chick-fil-A, but the Shake Shack bun's very good. So if I treat myself, it's a Shake Shack.
Do you remember the Beyond Meat guy, though, was saying that Maha's ruined all of this? He basically said our earnings are bad because people don't want meat-free items. They don't want gluten-free buns. They all just want, like, red meat because that's what this government is projecting out there.
Right, for some. Yeah, for some. All right, on our radar this morning, the U.S. and Iran ceasefire appears to be holding ahead of tomorrow's peace talks in Islamabad. Meanwhile, Israel vowing to continue strikes on Lebanon, given what's going on with Hezbollah. Ceasefire negotiations between the two countries set for next week. And President Trump demanding Iran open the Strait of Hormuz, calling the country's effective closure of the waterway dishonorable. In a separate post, the president pressuring Tehran to stop charging tolls for tankers to cross the strait. And the White House is warning employees against insider trading. An internal staff-wide email was sent following a series of well-timed and profitable bets around the president's military decisions in Venezuela and Iran. This is very interesting because we can all see the data about a number of massive trades that were put on at very interesting timings that paid off if you were to know potentially some information that the president was going to make in terms of Venezuela or Iran.
And I think the timing of this email is significant. It happened on March 24th, which was the day after all of this. The day before, to your point, the president had said that he had productive conversations with Tehran, a pause in fighting, stock surge, and 15 minutes before that, you had huge amounts of trading. I think it's going to be interesting to see how this settles out with the likes of Polymarket and the other event betting kind of websites, because oversight for them is a little bit less, regulation is a little bit less. They've had problems before, and still a lot of these trades have been frozen by these platforms who are trying to figure out exactly how to handle them. They want more liquidity. Why would you trade on these things if you're just going to get a bunch of insider trading get done?
Right, exactly. It feels like if you're just anyone, it's going to be stacked against you. I know there's been so much talk about this with Iran, but remember Venezuela? A user gained roughly $450,000 on Polymarket, perfectly timed bet regarding the arrest and capture of Nicolas Maduro.
It also keeps happening. It happened with the Nobel Peace Prize, too. Right before they announced the winner, you saw the contract surging for the eventual winner. It's these kind of sketchy things. Again, I get back to this idea of if you're a regular person, you don't have inside information, it looks less attractive to you.
And actually, it's becoming a campaign issue. Rahm Emanuel is talking about the fact that they need to ban anyone working in the government from betting on these kind of sites, Polymarket and Kalshi.
That feels pretty straightforward to me.
Yeah.
I feel like that,
All right,
that
well,
probably wouldn't be controversial, you'd hope.
Probably not, but then Congress would need to vote for it.
True.
We'll see. All right, crude climbing back close to $100 a barrel. Saudi Arabia saying its output has been cut by more than 500,000 barrels a day due to Iranian attacks. Bloomberg's Anthony DiPaola joins us now from Dubai. Anthony, thank you so much for joining us. We're talking about how this ceasefire is holding on, but we have seen attacks continue on key facilities in Saudi Arabia as well as Kuwait. What does the damage look like?
Good morning, Annmarie. Yeah, you're right. The ceasefire is there. It came in our time here in the Middle East on Wednesday morning, just about an hour or so before that deadline from Donald Trump that he was going to go after the power plants and other facilities in Iran, likely causing reciprocal strikes in the Gulf. But we did see a strike on a key pipeline in Saudi Arabia just hours after that ceasefire happened. That knocked out, hit a pumping station, knocked out about 10% of the flow capacity on that pipeline. And that pipeline is a major export route for Saudi crude. With Hormuz still blocked, the Iranians claim it's open, but you need to go to the Iranians to be able to get through it. So effectively, it's blocked. We haven't seen tankers go through there. The Saudis, therefore, are using their cross-country pipeline that takes oil from their main fields in the deserts around the Persian Gulf, all the way across the country to the port of Yanbu on the Red Sea, where it's able to access global markets. Already, exports, the export capacity from that port is less than Saudi Arabia's normal exports to the market. And this attack, taking about 10% of that capacity off, risks hurting that even more. So that just highlights some of the risks to the infrastructure and some of the tenuous nature of oil markets right now as we really wait to see if Hormuz can reopen and if vessels can continue flowing through there to get that oil back to the market that needs to rebalance markets, Annmarie.
Anthony, thank you so much for your insight this morning. Bloomberg's Anthony DiPaola in Dubai. Ellen Wald of the Atlantic Council writing this morning, there is no maritime certainty and there has been no indication from Iran that ships will be allowed to transit near its waters safely. Ellen joins us now. Ellen, it's an excellent point because although you've heard the White House say there has been some uptick, even the president yesterday said he doesn't like what he's seeing and he doesn't like that they're going to be charging some tolls. Is that the big item on the negotiating table this weekend?
I think that combined with some continued, attacks, the attack on the East-West pipeline and the one on Kuwait have to be the very first orders of business because it's not even what the ceasefire, agreed to. This is not a ceasefire. If in fact ships cannot transit and areas including important oil installations in the Middle East are still being subject to drone attacks, whether it's from Iran or whether it's from Iranian proxies in other areas, it's basically the same thing at this point.
When Tehran says they're going to be charging tolls, and we have seen them charge tolls, I know one vessel paid about $2 million for a safe transit through the Strait. Is that acceptable to Gulf countries?
That's not acceptable to anyone. I mean, there are, international maritime conventions that countries agree to, which say that, you can't just charge tolls or you can't charge for passage of, in the seas and in areas. I mean, this is a very fundamental idea. This is not the Suez Canal. This is not the Panama Canal. The Strait of Hormuz was not constructed by a particular country. It doesn't even lie within Iran's territorial bounds. It's not even the same as, when you consider the Dardanelles, which is an area that, Turkey is on both sides of that waterway and does charge a very minimal, fee for ships that's generally considered to account for like Coast Guard services and safe passage. Iran's not doing anything here. It's just charging a toll because it can and to assert its dominance. And that's not acceptable in, international maritime agreements that we've had for, hundreds of years now.
Ellen, beyond the strait itself, as our reporter Anthony DiPaolo was pointing out, you also had this attack on Saudi's East-West pipeline. How big of a threat are those pipelines and for Hezbollah, the other regional proxies of Iran? What does the threat look like there for that type of disruption to occur?
That's a huge issue. And, it's been the kind of threat that we've been basically expecting and waiting for the entire war, is that Iran will hit something that's vital for, vital oil infrastructure in the region. And hitting the East-West pipeline, hitting a pumping station there, they've taken out vital oil infrastructure now. And that's not going to be repaired overnight necessarily. And so, once you've got Saudi Arabia not really able to export out of the Persian Gulf, and now their other outlet is damaged. Plus, you've got Yanbu, their port on the other side, under threat from Iranian proxies like the Houthis. There's still a very, very serious threat to oil, to ships, to trade in this region that cannot be ignored. If in fact more severe, and the threat has even grown since the earlier days of the war because these missiles are finding their targets now.
So given all those risks, Ellen, you still have an oil futures market by this time next year is pricing something around $75 a barrel. Do you think the risk is greater than that? Do you think there should be more of a premium to just how expensive oil and energy prices will be, considering either lasting scars or continued concerns on the battlefront?
Absolutely. I think that the price that oil is going for on the market does not reflect either the reality on the ground of what actual customers are paying for oil, and it also doesn't reflect the reality that it's going to take a while to get things back to where they were. I mean, we're not even, there's going to be a backlog of ships for at least a month, okay? And that doesn't even take into account the fact that, is serious damage that's going to take months, if not on the LNG front, years to repair. And that's not being reflected in the oil market. Now, it's possible that over time, other producers will take up the slack, but that doesn't mean that oil is really being priced considering the damage that's done, the amount of time it's going to take to get things back to normal. If we get a true ceasefire, say today, and a diplomatic resolution, but as long as the IRGC remain in control and there's this possibility, they now know that they can charge this toll, they can stop traffic. And so if they're going to remain in power, this is always going to be hanging over the heads of any ship that transits the strait. There's going to be, if this stands, if this government stands, there's going to be a risk premium on oil that has to leave the strait for years to come.
Well, Dr. Sultan, in a LinkedIn post this week, said the final cargoes that transited the Strait of Hormuz before the conflict are now arriving at their destinations. This is where the paper-traded markets are meeting physical reality, and the 40-day gap in global energy flows is truly exposed. Ellen, at the same time, we're supposed to have this evening at midnight a key waiver expire for purchases of Russian crude. How challenging is the energy shock going to get? How much more acute is it going to feel for Asian countries?
I think it's going to feel more acute unless they just decide to defy this waiver and continue to purchase from Russia, or the Trump administration could decide to renew it. Although, that's a card that they hold. If they decide not to renew that waiver, that could help put additional pressure on Iran to make these changes. Now, I don't think Iran is going to do that because this is Iran's final card that it holds, and so Iran is not going to let that go without a fight. And so I do think that the market, the paper market, the market we see on our computers every day, that's not reflecting the reality of what's about to hit Asia.
Ellen, thank you so much for your time this morning. Ellen Wald of the Atlantic Council. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief. Russia and Ukraine agreed to a ceasefire from Saturday afternoon through Sunday to mark Orthodox Easter. Russian President Vladimir Putin made a similar gesture of an Easter truce last year, during which Russia and Ukraine accused each other of breaches. China's exports of electric vehicles jumped to a record high in March as the global energy shock renewed interest in EVs. Overseas shipments jumped 140% from a year ago, with BYD accounting for about 1/3 of the total. And Treasury Secretary Scott Bessent and Fed Chair Jerome Powell warning Wall Street that Anthropic's latest AI model could usher in a new era of cyber risk. Regulators fear Anthropic's Mythos system is powerful enough to identify and exploit major vulnerabilities across the financial grid. And that's your Bloomberg brief. Up next this morning, owning opportunity.
The bond market looks pretty good. It's held in phenomenally well over the last 6 weeks, and investors don't want to miss this opportunity the way they did last year with Liberation Day.
Krishna Guha of Evercore ISI joins us next. You don't want to miss that conversation. You're watching Bloomberg Surveillance. Good morning. Welcome to Bloomberg Surveillance. A lot of risk this Friday morning, although obviously we're not seeing that in the futures market. First, the market needs to digest CPI data, very important inflation data coming up, because we will have the impact of the higher oil prices due to the war, part of this CPI data. And then on top of that, it's not really a weekend. It is a working weekend, given the fact that we have incredibly important discussions taking place in Islamabad between the U.S. and Iranian delegations. Under surveillance this morning, owning opportunity.
Investors are underallocated to fixed income. They don't want to miss this backup in yields. They want to get into the bond market. It starts with, where is fair value? I think the Fed is in hibernation mode. I like that. The bond market looks pretty good. It's held in phenomenally well over the last 6 weeks. And investors don't want to miss this opportunity the way they did last year with Liberation Day.
Here's the latest. Yields holding steady as investors await fresh inflation data for clues into the Fed's next move. Krishna Guha of Evercore ISI writing, the market is now discounting a clear skew to one cut from the Fed this year. Krishna joins us now. Krishna, I like what Bob Michael of JPMorgan said to us yesterday. The Fed's basically in hibernation mode. Do they need more information right now?
Oh, sure they do, and they're in no rush whatsoever. Look, I think the baseline is that the Fed, having got some reassurance from the last labor report that the labor market is okay, is going to spend the next roughly 6 months policing the inflation shock from oil, making sure that it's not seeping into core inflation more than a bit, making sure it's not contaminating expectations or wage price setting behaviors. And if it validates that, and if it validates underlying disinflation is still coming through as they expect, then and only then they can turn back to consideration of a rate cut.
Are you confident that that scenario can play out, Krishna? We're going to get CPI in just under 2 hours' time. You also have PCE data already from February showing a persistent uptick in inflation. Do you think it can remain well behaved despite the disruption to energy markets?
So I think the answer to that is yes. Am I 100% certain the answer to that is yes? No. And if I was a central banker, I would go out of my way to be wary, careful, et cetera, et cetera, et cetera. But look, even the core PCE print that we got yesterday actually wasn't so bad. Why? Because the heat was in goods. We understand why goods are strong. It's mostly tariff pass-through with a little nudge up in that computer software and accessories category from spillovers from AI CapEx. But the real question is core services ex-housing behaving, or is it getting stuck? And we actually got a quite reassuring soft print on those services inflation data yesterday. Now, of course, when CPI comes out today, everything will be swamped by the initial headline inflation shock from energy. The question, though, is 6 months from now, is that turning out to be a one and done or something more serious?
We do, though, keep getting these supply shocks to the economy, and everyone is this one-off. It's something that Michael Purves of Tallbacken has discussed with Annmarie and myself, that maybe it is just more of a feature of this American economy, the fact that we are fragile enough to continue to get supply shocks. Should there be some level at which we just, not forever, but for a long time, just price in higher inflation that is just a feature we can't escape?
So I don't think it's a feature of the fragility of the US economy. I think if you wanted to make that argument, the argument you'd make is that the world in some more structural sense has become more geopolitically unstable, more vulnerable to a range of shocks, whether they're conflict-related shocks, indeed whether they're pandemic-related shocks, trade-related shocks. And it's from those that you might get a higher frequency of supply shocks than we've been used to in the past. I think that's certainly something we should take seriously. Is it going to mean that inflation remains, 3% or higher than that going forward? I don't think so in the base case. Though again, I would police it if I was the Fed. I think it's more likely that inflation over the sort of medium to long haul is a bit more volatile rather than averaging a lot higher under this regime.
Can a Kevin Warsh come in and do nothing?
Well, I think Kevin will be angling to get to a point where he can justify cutting rates. That's not the same thing as cutting rates get out the door. I think Kevin's posture will be that, look, we have faced a series of serious inflation shocks on a backward-looking basis. That was the pandemic, then the tariffs, and now oil. But looking forward, we have the AI shock unfolding, which is going to lift productivity and is going to act as a force of disinflation. So I think Kevin is going to try to get us to look forward. After all, monetary policy is supposed to be forward-looking rather than look backward. And really the key debate and the judgments that will have to be made will be about trying to get the right balance between that forward-looking perspective, which should, in my view, incorporate AI productivity and disinflation, and the necessary data dependence to really understand whether these shocks that we have experienced have just accumulated to a point where they're starting to corrupt the underlying inflation process.
Just quickly, Krishna, do you think he is going to be confirmed in time for May 16th?
It's looking dicey at this point, right? We've had some media reports over the last 24 hours suggesting that a sort of tentative 16th April, that would have been next week, hearing is now not going to happen, and there's no date yet set for when Warsh will have his hearing. Why is that? Well, very obviously because they haven't resolved the underlying issue, which is the DOJ has not buried its investigation into Powell, and therefore Tillis won't release the hold on Warsh. There's no point really him coming to do his hearing. It looks to me like it's increasingly likely that Kevin won't be ready, confirmed in time to take over on May 16th, and that separately, even if he's confirmed at the last minute, gets in the door on May 16th, it feels to me increasingly likely that Powell is going to stay on for a period of some months as a regular governor.
Wow. Krishna Guha, what a call there of Evercore ISI. Thank you so much for joining us. Coming up next, Tiffany McGhee of Pivotal Advisors, Michael Zezas of Morgan Stanley, David Tinsley of Bank of America Institute, and Bob McNally of Rapidan Energy Advisors, as we do see oil ticking up higher today as we head into those talks tomorrow in Islamabad with the Strait of Hormuz effectively still closed. You're watching Bloomberg Surveillance.
CPI will give us the first look at how these higher energy prices are seeping out into the broader economy.
This is a big hit to consumers and households and businesses.
We don't actually think these increases in oil prices will have all that big of an effect on things.
We're not seeing sustained inflationary pressures.
We in the markets accept that a 2% inflation target is a myth.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning and welcome to the second hour of Bloomberg Surveillance at 7 o'clock here in New York City. Markets are waiting for Islamabad as delegations from Iran and the United States prepare for talks in Pakistan. The ceasefire remains fragile, and the president, though, he's frustrated with the lack of traffic in the Strait of Hormuz. On Truth Social, Trump said Iran is doing a very poor job. This is not the agreement we have. Of course, it comes as well as a key license from the Treasury Department allowing the purchase of Russian oil is going to expire at midnight. We'll see the war's impact on inflation data later today, Danny. This is going to be really important inflation data, given the fact that it includes all of the spikes we've seen in energy prices because of the war in Iran.
It's the first time we're going to get a key piece of economic data that has that. It also follows February data, PCE, which we learned this week, which was sticky before the war even started. So it's a difficult way and idea to take risk this morning, because it's not even just that. What if everything looks good and you load up the boat on risk and you start to short treasuries or whatever you want to do, and then all of a sudden talks fall apart on the weekend? How do you position for something like that? It is incredibly complicated, and there are so many factors going into it.
I mean, I've been even thinking about what if one side doesn't show up this weekend? This is obviously a group of people that there's no trust in this relationship. There's never been trust in this relationship. And the one thing the United States really wants is the one piece of leverage the Iranians have. And I don't see any indication yet that they're willing to give up their stronghold on the Strait.
The point plans are so far apart at this moment. And add to that, you've been also talking about this morning, Annmarie, is the fact that you're also going to have Israeli and Lebanese delegations meeting. They're talking at the ambassador level, according to the Wall Street Journal. And that has been a key reason why Iran has said that the U.S. has violated the ceasefire, that Iran continues to attack Lebanon. So it's not even just the Iranian talks with the United States. It's also that, too.
It's multiple parties. I think Maha put it really well this morning from Carnegie Endowment. She said the maximum of what Iran is willing to offer is not the minimum of what the U.S. will accept, which is why the fact that they're just meeting might actually be the success of these negotiations this weekend. So markets this morning, of course, they are waiting for whatever comes out of these talks this weekend, but they're pretty much pricing in this ceasefire. You have equity futures this morning relatively flat, but we've had 7 days of gains on the S&P 500. U.S. Treasury yield up slightly, 4.28%. And New York crude this morning, $98.11. Oil is going to be the focus when it comes to these talks this weekend. And if we see any inclination from the Iranians to start allowing more free flow of oil vessels and cargo through the Strait of Hormuz. Coming up this morning, Tiffany McGhee of Pivotal Advisors as a relief rally runs out of steam. Michael Zezas of Morgan Stanley ahead of U.S.-Iran peace talks, and Bob McNally of Rapidan Energy as Tehran tightens its grip on Hormuz flows. We begin this hour with stocks flat and crude climbing as President Trump unleashes new threats to Iran over the Strait of Hormuz. Bloomberg's Jumana Bercecci joins us now from Dubai. Jumana, thanks so much. And I know you're going to have a very busy weekend ahead. What can we expect?
Yeah, well, the challenge here is turning what has been quite a fragile truce, but it is still largely being upheld. And I should say that as of Friday, there have been no reported incidents of strikes either way and anywhere in the region as it pertains to the regional ceasefire. So it is being upheld. But the challenge, of course, is to take this temporary truce and turn it into a longer-term permanent cessation of hostilities. And now we know that the U.S. delegation is on their way or reportedly has arrived in Islamabad in the early hours of this morning, led by J.D. Vance. Unclear at this point whether the Iranian delegation has actually landed. There hasn't been confirmation yet, though overnight reports suggest that they will be represented by the Speaker of the Parliament, that is Mohammad Ghalibaf, who's been very vocal over the last couple of weeks on social media about their intransigence and really reaffirming some of those key points that they've been insisting on, including the right of sovereignty over the Strait of Hormuz, and then the Iranian Foreign Minister Abbas Araghchi as well. Now, one of the big questions that you and Danny were just talking about is whether the Lebanon situation is going to torpedo the discussions. And I think what has become apparent in the last 24 hours is the White House and President Trump himself did want to see a de-escalation of sorts on the Hezbollah front in Lebanon, especially after that day of extremely heavy bombardment on Wednesday, which led to the deaths of over 300 people in Lebanon. And so yesterday evening, we got word from the Israeli Prime Minister saying that they are willing to start direct discussions with the Lebanese government, and to be clear here, this is the Lebanese government, it is not Hezbollah themselves, to talk about the further disarmament of Hezbollah and a potential longer-term security arrangement. That seemed to be enough in order for the U.S. to push forwards with the negotiations. The question is it enough for the Iranian side? And they are maintaining that the regional ceasefire has to include Lebanon as well. I think many in Lebanon would say that they have the right to actually assert their own sovereignty in this situation. So one thing to bear in mind, the other big topic, of course, is the Strait of Hormuz. Overnight, President Trump saying that Iran are not keeping to the terms of the ceasefire, which is an unconditional opening of the strait, free passage for all vessels. They shouldn't be charging a transit fee, which is what reportedly they are doing. And so the question here is whether we can come out the other side of these negotiations with that free unconditional passage for vessels through the Strait of Hormuz and some of the other terms that the U.S. were insisting on even before the war started, including minimal enrichment, possible retrieval of that enriched uranium stockpile, and Iran really ceasing to shore up and to provide support to some of their proxies in the region, crucial to the Hezbollah question as well. So there's still a lot to get through in the coming days.
Jumana, thank you so much. Bloomberg's Jumana Bersachi in Dubai. Here's the view from Wall Street this morning. Tiffany McGhee of Pivotal Advisors writing markets are sensitive to any changes in energy flows or escalation risk. The recent move in equities reflects relief around geopolitics, but not a full resolution. Tiffany joins us now for more. So, Tiffany, when it comes to the two key points going into the weekend, we have inflation data at 8:30, and then, of course, these talks on Saturday. What do you think the market's going to be more focused on?
Well, I think, a good example of this is we can look at what happened yesterday, right? And so, yesterday looked like a strong day on the surface, but the details kind of really tell a more nuanced story. So you had stocks higher, but yields were also moving up a little over like 4.3%, and oil back to near $100. And so this really wasn't a clean risk rally at all. It was really more markets adjusting to uncertainty and not pricing it away. So I think as we kind of go into the weekend, we still have a lot of uncertainty. So, that's something that we really need to continue to watch.
How much of all of this, Tiffany, is just positioning? This is something I've been asking constantly over the past week because the market moves, yes, on ceasefire hopes, but otherwise have been odd. For example, software stocks plunged 5% over the past 3 days alongside energy. There's no logical reason for software to be falling in a ceasefire unless it's just hedge funds re-upping on their short positions just because this allows them to go back to the bets they had before. So how much of this market is not really being priced on fundamentals, but is just simply positioning?
Well, I think it's a combination of both, and so listen, we've got, I think that we are really in a headline environment. And so that's really moving the markets. We can look at even what's going on over the past few weeks with the price of oil, with the fact that even about 2 weeks ago, we saw all this volatility in the market, but yet earnings expectations continue to increase. And that's one thing we'll also kind of be looking at heading into like earnings season. We are really in a fundamentals-driven market right now. It's really not about hype anymore.
Bank of America's Michael Hartnett is out with a note this morning saying that investors should flock into commodities for the next few years. He thinks that a surge in commodities is going to last for that a few years, and that in a portfolio, it might even supplant popularity around equities, that this becomes a big chunk to diversify away from bonds. Do you think commodities deserve that big, shiny place in a portfolio as well?
Listen, so our clients are institutional investors. And so, diversification is really the key for us. When we think about positioning, we're really focused on our clients' strategic asset allocation and then making those tactical moves. Commodities do have a place in a portfolio. We like to really invest in real assets. We like a combination of real assets, infrastructure, REITs, commodities. All of those things act as a diversifier to traditional stocks and bonds. And so, yeah, I definitely do think that they have a place in the portfolio.
What place does gold have in the portfolio, Tiffany? This should be geopolitical angst, concern about what the Fed is going to do. It seems like a good time to be piling into the precious metal, but it's been trading a lot just like a momentum trade.
It has. And so, when I think about how we position portfolios for our clients. Again, we set that strategic asset allocation first. Gold is always a portion of our client's portfolio, but we do so through a fund structure where we have exposure to other metals as well. So we don't have a ton of direct exposure to gold, but that's how we like to play it. We like to play it in a more diversified position.
So if there aren't enough risk headlines today with CPI, talks and negotiations over the weekend, next week we really get into the earnings season in earnest. It'll kick off with Goldman Sachs on Monday. Tiffany, what are you looking out for? What signals are you hoping to hear from the big banks in order to understand where we are in this American economy and in the financial sector?
Yeah, so I think as we head into earnings season, I think the numbers really matter, but the messaging matters more. So we're watching a few things. We're definitely looking at margins. Can companies really absorb the higher energy costs, or are they passing them through to their customers? We're also, on the AI front, looking for that AI payoff. So, we know AI is driving growth, but are we seeing real returns yet? That's really important. And so we'll also be paying attention to guidance. And so, with much uncertainty, right, we're in this period of uncertainty, forward guidance really matters more than the quarter to us. And also we're looking at consumer sensitivity. Are higher energy prices starting to impact demand? So it's really like a show me earnings season, not a tell me earnings season.
That's a good way to put it. Tiffany, thank you so much for joining us this morning. Tiffany McGhee of Pivotal Advisors. Let's get you an update on stories elsewhere we're watching this morning. Here's your Bloomberg brief. The U.S. and Iran heading into high-level peace talks in Pakistan tomorrow. Ahead of the talks, President Donald Trump warning Iran against charging fees on tankers passing through the Strait of Hormuz. Israeli Prime Minister Benjamin Netanyahu agreeing to direct negotiations with Lebanon. Netanyahu saying there is no ceasefire between the nations and vowed to keep attacking Iran-backed Hezbollah. The Wall Street Journal reporting the talks will start at the ambassador level. And the 4 astronauts of NASA's Artemis 2 are on their way home. Their mission broke records, taking them further from Earth than any humans had ever been, as they got closer to the surface of the moon than any astronaut in more than half a century. Artemis 2 is expected to splash down in the Pacific Ocean tonight, and I cannot wait to hear what those astronauts have to say.
I always feel bad for them when the cameras come out and they're expected to be on camera right when they get off, because they can barely walk. They've been without gravity for a while.
We should give them a little bit of a moment, a breather, see their families, maybe shower, have something to eat. But it's so cool. These pictures are incredible.
It is really, really cool to see the other side of the moon in such high definition, to see the Earth. It's always a bit humbling to be like, there are so many horrible and crazy things happening in the world, but here it is from the look back from Earth, what it really is, just a little blue orb.
Well, we look forward to their journey home. That's your Bloomberg Brief. Up next on the program, a fragile peace.
This is a fragile truce. Ceasefires are fragile by nature. We have seen an uptick of traffic in the Strait, and I will reiterate the president's expectation and demand that the Strait of Hormuz is reopened immediately, quickly, and safely.
Zezas of Morgan Stanley joins us next. You're watching Bloomberg Surveillance. Good morning. Welcome to Bloomberg Surveillance. I'm Annmarie Hordern. Alongside Danny Berger today, Lisa and Jonathan are off. Under surveillance this morning, a fragile peace.
This is a fragile truce. Ceasefires are fragile by nature. Of course, we want to see the ceasefire effectuated and abided by all parties as quickly as possible. We have seen an uptick of traffic in the Strait, and I will reiterate the president's expectation and demand that the Strait of Hormuz is reopened immediately, quickly, and safely.
Here's the latest. President Trump putting pressure on Iran, demanding Tehran reopen the Strait of Hormuz ahead of peace talks in Pakistan tomorrow. Bloomberg's Tyler Kendall joins us now. So, Tyler, when is J.D. Vance set to arrive in Pakistan, and what does it look like in terms of success for this administration?
Hey, Annmarie, good morning. Well, Vice President J.D. Vance is making his way over to Pakistan for these talks to start tomorrow. He'll be accompanied by Special Envoy Steve Witkoff, as well as the president's son-in-law, Jared Kushner. Though people familiar with the matter do tell Bloomberg News the fact that the vice president is now taking the lead in these talks may indicate a more cautious approach as the U.S. looks for a potential off-ramp. The fact that the talks are happening is considered to be forward progress, considering that the demands, at least publicly, from both sides appear very far apart. And the White House does maintain that these talks are on track. Even after yesterday, it appeared that they had hit that potential roadblock over Israel's operations in Lebanon against the Iranian-backed militant group Hezbollah. Now, the Israeli Prime Minister Benjamin Netanyahu said earlier today that those operations in Lebanon will continue, though it does appear that the pledge of direct talks between Israel and Lebanon have helped to smooth the path forward. But we still know there is a lot that has to get done, not just for a longer-term agreement, but to make sure that this 2-week ceasefire is upheld. Because if President Trump's posts last night on Truth Social are any indication, the U.S. is going to ramp up the pressure to ensure the reopening of the Strait of Hormuz. Because, Annmarie, at this point, it doesn't appear that Iran is going to let up that leverage, though there were some new headlines this morning breaking, including that a Russian flag tanker has appeared to exited the strait and that 7 additional Malaysian flag tankers are set to depart as well. But still, we are only at a fraction of the total vessel traffic where we were before the war began.
It's pay for play. Bloomberg's Tyler Kendall, thank you so much for joining us. Joining now to continue the conversation is Michael Zezas of Morgan Stanley. So you say, good morning, Michael.
Morning.
Thanks for joining us. So you say you have to stay humble,
Yeah.
and it's a scenario-based approach investors should be looking at. So walk us through the scenarios you're thinking about as we head into this weekend.
Yeah, so again, I think it's really difficult to understand what happens in the next 24, 48, 72 hours. But if we think a little more medium term, a couple weeks out, I think the incentives are pretty well aligned across most actors to at least have Hormuz opened in some meaningful way. Complete return to normal, that part's really unclear, right? But if you're getting some oil and some natural gas flowing back through in some meaningful way, then our commodity strategy team, led by Martin Ratz, has done a really wonderful job laying out the price arrangements across different. A full normalization, of course, you maybe could get something, in the $60 to $80 a barrel. We might be living more in this partial reopening scenario, $80 to $100 a barrel. And of course, if the whole thing breaks down, and we thought it broke down sustainably, then the demand destruction point that you could go to is $120, $150 a barrel. But if we're in that kind of 80 to 100 range, even if you sort of have this fragile piece, fragile equilibrium, that's the type of thing that we think is still consistent with positive U.S. economic growth, the equity markets rallying back, even if it is suboptimal relative to the conditions you had coming into the conflict.
Why do you think, though, there is this consensus that the Iranians really are ready to open the strait and have it be normal? Because this is their only piece of leverage with Washington.
Yeah, I mean, I don't know there's a consensus that everyone's ready for it to be normal. I mean,
well, look at the price of oil, and it looks kind of...
Yeah, well, I think that's where price matters quite a bit, right? So normal, if we define normal as what existed before the conflict started, then I think you'd expect to see prices of oil be much, much lower than they are right now. So the premium of where you are right now, and maybe, even if you get down to something like $80 a barrel, that premium reflects potential that you're only getting partially reopened and probably this kind of long-term overhang of risk, right? The U.S. and Israel might deem it to be in their interest periodically, if Iran is starting to rebuild militarily, to restart conflict. And so if you're going to have this kind of lingering risk and lingering uncertainty of military conflict, until you sort of rewire supply chains around that, you remove Hormuz as a choke point, there's always going to be this lingering premium that would go on top of what would otherwise be normal, and that would be quite a bit lower prices than what we're seeing today on oil.
Just to be clear, I want to make sure I didn't mishear you when you were saying that $100 a barrel, that's something that the American economy could live with. We could still have strong economic growth. Companies would be okay. Is that your estimation?
That's what our economists say. You're sort of starting from a point right now, okay, at least over the course of the rest of this year, where the U.S. consumer is strong enough. There's enough capex flowing through the economy because of secular trends, AI industrial build out, for example. And frankly, one of the trends that's reinforced by this dynamic, which is supply chain realignment and companies having to spend to sort of immunize their supply chains from various choke points, Hormuz just kind of being one of them. So with that much capex flowing and that much consumer spending going, the dynamic here where the economy wouldn't be strong enough would be if oil prices go to the point where it creates like real demand destruction, not just on people driving, but also the cost of that starts to sort of seep into other areas of the economy. Our economist's assessment is that you've got to have oil above $120 a barrel for several months before that would happen.
Is there not just some, though, psychological dynamic to seeing above $4 on average at the pump, that you get a consumer that starts to pull back, that it changes consumer behavior? Or is that still not enough?
Well, it is. It's just it's not enough to actually reduce growth in a meaningful way down, or substantially.
What about in pockets of the economy, like consumer companies or things like that? Are there pockets of the economy that start to look weaker?
Well, it certainly exacerbates the trend of the K-shaped economy, right? Because if you're talking about the sort of basket of goods that different types of consumers have, gasoline obviously makes up a much bigger portion of the consumer bucket on the lower end of the economy. So that does matter quite a bit. But in the aggregate, if we're talking about GDP and can we continue to grow, and the CapEx that's sort of boosting that, for example, the AI industrial build out, I think it's about 25% of growth this year, and we think that's sort of relatively immune to what's going on right now, that is still going to push GDP.
What about, because I know you have some thoughts about the midterm elections.
Yeah.
Could Republicans withstand $100 oil? Maybe the economy can, but...
Yeah. I mean, listen, the prediction markets say no. The polls suggest the same thing. So investors do have to be thinking about a midterm election dynamic where congressional power shifts into the Democrats' hands.
Even on the Senate, you think?
Well, again, I think that's more of a toss-up. But the House of Representatives, again, if you look at polls and prediction markets, would suggest that it's a likelihood at this point that the Democrats are taking over. I don't know that there's much of a functional, again, just purely from the investor's perspective, that there's much of a functional difference between whether the Democrats get the House or the House and the Senate. Or said differently, what policy changes come from either of those outcomes that would affect markets? And we've been arguing the answer is really not that much, because a lot of the policy dynamics we're talking about right now, including what's going on with Iran, it's purely flowing through executive power. So maybe it sends a soft signal about 2029 and future policies, but I think that would be far too speculative to actually change investment strategy around.
But if the administration wants to get through some more fiscal spending, they would have to do it before November.
Yeah, very likely, very likely.
Because they have a defense budget, a higher defense budget they're looking for.
Yeah, very likely. And therefore, that's probably what's going to happen. And again, sort of relieves the pressure on the midterms to catalyze some other outcome that the market might be concerned about or looking for.
Could the bond market handle more fiscal spending from this administration? We're talking about $1.5 trillion defense budget.
Yeah, I think so. I mean, listen, I think it's not that there is some a magical number or limit that the bond market can or can't handle. So I think in the aggregate, the numbers that we're talking about spread out over a 10-year basis are not all that meaningful. But, I mean, certainly we don't seem to have a set of policies, or we're not on a policy trajectory that's specifically aimed at fiscal sustainability or changing deficit to GDP in a meaningful way. Perhaps it is sort of leveraging the idea that we're going to have better growth in the future, maybe driven by productivity, driven by AI, but not this sort of proactive approach by Congress to address it.
Michael, thank you so much
Thanks
for
so much.
your important work this morning. Michael Zezas of Morgan Stanley, especially as we think about the scenarios that could come out of this weekend with these talks happening in Pakistan tomorrow. Coming to the program, David Tinsley of Bank of America Institute on the sharp jump in consumer spending. Plus, Christina Aquino is back with us this morning. Service now falling after a downgrade from UBS. The stock is down more than 1%. More on that story next. You're watching Bloomberg Surveillance. Good morning. Welcome to Bloomberg Surveillance. I'm Annmarie Hordern. It is Friday, 7:30 a.m. We're just an hour away from CPI data. I'm joined by Danny Berger. John and Lisa are off today. And Danny, we have equity futures just relatively flat. But you have to remember, we've had 7 consecutive days to the upside, even amidst this war right now, where the truce is sort of there. You see an off-ramp both sides maybe want to take. They are meeting, which someone told me last night, the fact that they are meeting is a success. But at the same time, we really don't understand how long this can hold for, and is it really credible?
It's a market that is just happy enough with a path to peace, not full-on peace. It is remarkable if you look at where we are. We are down now only 2.2% from all-time highs. On the year, we're only down 0.3%. It's a market that's been extremely resilient. I wonder if that will change today, Annmarie, because it's the pattern we've seen for this market. You get a rally on Monday and Tuesday, and you start to weaken as the end of the week comes through. We haven't seen that this week, to your point of 7 days of a rally, but will CPI change that?
And there's really no weekend this weekend because these talks are really important tomorrow. Of course, in the bond space, nothing really changing here. We have 4.30 on the 10-year yield. Again, this will be important in terms of what happens with the CPI data. And what does the Fed do with that CPI data? Do they look through this inflationary shock we may see because of what is going on with oil prices and potentially a question mark about how this all ends? And that is why this board is so important right now. Brent crude and WTI. Wow, look at WTI for the June contract. We are sub $90. This is something this White House would like to see.
It's pretty remarkable considering the lack of traffic going through the Strait of Hormuz, considering all the risk events on the weekend. And then if you look further out in contracts, we easily get below $80 a barrel before this time next year. It's something Ellen Wald was talking about, that there does remain, and I have to say you've been great on this too, Annmarie, there does remain this disconnect between physical markets and paper markets.
Absolutely. It's a complete disconnect because the Strait of Hormuz is still essentially shut. I say controlled by Iran because they are letting some vessels through, but far cry from the normal flows we saw before the start of this conflict. All right, we're 2 hours away from the cash open. Let's get you some morning movers with Christine Aquino. Hey, Christine.
Hey, Annmarie. All right, let's take a look at optics shares this morning. Still going strong ahead of the market open. That is because of comments from Lumentum saying that demand for its products from the biggest U.S. tech companies still accelerating. That company also saying that they are booked solid. They are on track to fulfill order books through 2028. CEO Michael Hurlston actually saying that CapEx from hyperscalers does not seem to have any end in sight. It's falling further behind in fulfilling demand. Not exactly a bad problem to have for the company. Tell you what, though, a company that's not doing too well in the pre-market, ServiceNow, those shares are down more than 1% ahead of the cash open. That comes after a downgrade by UBS to outperform with a $100 price target. Those shares actually fell to a 3-year low this week because of lingering concerns over AI disruption in the sector. We will get a full picture of the extent of the damage from that narrative when ServiceNow reports its results on April 22nd. Another company that is being challenged in the pre-market, Sweet Green. Well, actually now it's in the green at the moment, but we have seen a little bit of insider purchases this week reported by Goldman Sachs, purchases of more than $3 million. Those shares, though, have also been having a hard time this year. They're down 17%. They reported comparable sales falling 11% in the fourth quarter. That is the biggest decline since it went public. Higher lettuce sales, or higher lettuce prices, I should say, also factoring in February. So we'll see how that shakes out for its results when that comes in early May. Annmarie and Danny.
Thanks so much, Christine. I like how Christine's talking a lot about food at the end of these markets. I have to say, I'm not really a fan of Sweet Green, but haven't they gotten a lot of flack for skimping on chicken and things like that for people's salads that are like $20 plus?
Yeah, to the point where I don't know if you saw they launched this whole ad campaign of like, get rid of your protein bars. Here's this bowl of just chicken, and that's what you should be eating for your protein. So I feel like they kind of picked up on that. I don't know if it's helped them, but.
Oh, interesting. All right, well, stock's up today. On our radar this morning, U.S. and Iranian delegations meeting for high-level peace talks in Pakistan tomorrow. President Trump reiterating his demand for Tehran to reopen the Strait of Hormuz, calling the near closure, quote, dishonorable. And Israeli Prime Minister Benjamin Netanyahu agrees to direct negotiations with Lebanon. Netanyahu saying there is not currently a ceasefire between the two nations and vowed to keep attacking Iran-backed Hezbollah. And Treasury Secretary Scott Bessent and Fed Chair Jay Powell warning bank CEOs of Anthropic's new Mythos AI. Regulators fear the model is capable of exploiting major vulnerabilities across the financial grid. Now, this story is really interesting, I think really important. Two things that struck out to me immediately. First off, Bessent and Powell are having a meeting, and they're somewhat getting along, even though we see the president jawbone Powell all the time. And two, how dangerous and concerned are they about this AI that all the bank CEOs were summoned to Washington.
And it's not just them concerned. Anthropic itself is concerned. This is the first LLM that they're not rolling out to the broader public, that they're being selective because they basically saw this thing is so powerful, it can exploit all types of cyber vulnerabilities. This was from the New York Times article about this. I thought it was really interesting. So during safety tests for Mythos, an Anthropic research got an email from Mythos itself while he was eating a sandwich in the park. It was a surprise because the model wasn't supposed to be online. It had broken out of its test environment and then went on to brag about breaking the rules and attempted to cover its tracks. We're getting closer to this land of agentic AI, and it's kind of like, cool, so we'll boost productivity by 10%, but maybe like bring a complete downfall to human civilization.
Right, so robots just completely taking over. The other thing that is interesting is Anthropic's having a massive fight right now at the same time with the DoD. So they are in the crosshairs right now when it comes to a number of departments down in Washington.
And it also kind of feels like, I know it's not necessarily marketing for them, but like kind of good marketing. We're on the verge for an OpenAI IPO, and the two are really warring against each other. I don't know, when I read this story about Anthropic having such good of an LLM that they don't want to release it to the public, I'm like, hey, Anthropic seems ahead in this race.
What also scares me that if this is where Anthropic is, I wonder at this point, where is China when it comes to all of this? All right, investors are awaiting fresh inflation data due out in just under an hour. According to the Bank of America Institute March Consumer Checkpoint Survey, consumer spending picked up sharply in March, even beyond gasoline. David Tinsley of Bank of America Institute joins us now. David, thank you so much for joining us. I love the research. Give us a sense of where consumers are spending.
Well, I think, the big story in the data today, in the report today, is that consumers are weathering the madness of March really pretty well so far. So obviously we saw a big spike in gasoline. That goes without saying, gasoline spending. But even looking aside from that, we saw a 3.6% year-over-year rise in our card spending, which is the same tied with February's data, but noticeably stronger than the second half of last year. And when you look back over the year, where are people spending? It's discretionary services, travel, tourism, entertainment. Restaurants has had a couple of good months just of late. And there's also been something of a recovery on the retail spending side as well, electronics being one area that has picked up there. So it's quite broad-based, I'd say.
David, what's your understanding if prices for gasoline remain or go higher from where they are now with the national average above $4 a barrel? How does that impact other parts of spending for this American consumer?
Well, right now, I think it's worth thinking about this K-shape with regard to this. So this top-end consumer, this higher-income consumer, as we show in our report today, is seeing some really fast wage growth. It's at 5.2% year-over-year, the fastest it's been, or the biggest gap with lower-income wage growth, which is at 1%. Since this series, our data begins in the middle of the 2010s. So I think the higher end is going to weather the gasoline shock, and you have to keep that shock in perspective, I think, too. It's certainly not the largest we've seen over the last sort of 10, 15 years. They're going to weather that relatively satisfactorily for some period of time. Obviously, lots of uncertainty around where that goes. Lower income, their wage growth just 1%. We did notice in our report their discretionary spending growth did tick down in March. So I think where there's a little crack, if you like, is again at that lower income consumer end. But I think most of the consumers, helped by the fact that the equity market, as you were discussing earlier, is not sold off dramatically. Also this wage growth and, of course, tax refunds. So all those things are really kind of soothing the pain of higher gas prices for now.
But are tax refunds to some degree, David, kind of canceled out with higher gas prices? Do they not provide the benefit that they would have without this conflict?
Well, it would be nicer to have tax refunds without the high gas prices, and then you'd get an even stronger boost for discretionary. But, the way, in a way, to think about these tax refunds is they're up about 10 to 12% across the economy. That's hundreds of dollars for the typical household. In our data in March, the gasoline bill was up sort of, let's say, around $30, $40. a month. So when you think about that, you see that really the consumer, if they spent all their tax refund increase on gasoline, they could weather that shock for, say, 6 months plus. So one doesn't want that as the scenario, of course, because then there's less for discretionary. But still, it gives you an idea that the stimulus is helping soothe the consumers' headwinds from this gasoline price increase.
But it's not just gasoline at the pump. It's, of course, diesel prices, which impact, especially in America, farm to table, impacts grocery prices, coffee, beef, all of that is up, as well as electricity prices. So to Danny's point, I mean, if you consider everything in that, is it less than 6 months they can weather this storm?
Well, that is a fair point. You know, we only just begun to see some of those kind of like second round impacts, as you say, transport costs, plastic costs, packaging costs, etc., etc. So, you know, if those price increases, those price pressures get fed through, well, yes, then under those circumstances it could be less. I think when you hear from some corporates, though, they don't really necessarily feel in the place to push through a lot of price increases from those supply chain pressures. So, you know, that's to play for, I think, over the next 6 months or so.
And like we heard from Delta, they still see individuals traveling. When it comes to some extra money left over, where are you seeing consumers put that money to work?
Yeah, well, when we look at refund checks going into accounts and we look at 3 weeks after that refund check has hit the account, pretty obvious categories: electronics, clothing, airlines, as you were suggesting. There's a broad range of kind of nice to have discretionary areas that people are spending more on. Interestingly, though, people are also putting some of the money to debt repayment, credit card repayment, student loan repayment, which of course is also in some ways quite a good thing, because it means that they're building a slightly stronger balance sheet for the situation if does arise of future shocks.
David, thanks so much for your time this morning, for bringing us the insights of this report. David Tinsley of Bank of America Institute. We want to get you an update now on stories we're watching elsewhere this morning. Here's your Bloomberg brief. CoreWeave striking a $21 billion deal to supply computing power to Meta through 2023. The company provides AI cloud capacity to the Facebook parent from multiple data centers powered in part by NVIDIA's Rubin systems of chips. A change at the top of luxury retailer Dolce & Gabbana. Co-founder Stefano Gabbana resigned as chairman in December and is considering options for his 40% stake. Sources telling us here at Bloomberg the firm is entering a new round of debt talks with creditors. And First Lady Melania Trump denying close ties to late sex offender Jeffrey Epstein.
I never been friends with Epstein. Donald and I were invited to the same parties as Epstein from time to time, since overlapping in social circles is common in New York City and Palm Beach.
The First Lady also adding she never witnessed any of Epstein's crimes. Reports say many in the White House were caught off guard by the First Lady's statement. And that's your Bloomberg brief. Coming up on the program, reopening Hormuz.
The market is highly skeptical that the ceasefire is real, it will take, and it will actually open up the Strait of Hormuz. It's all about the barrels and the flow, and right now we're not seeing either of those two.
Bob McNally of Rapidan Energy joins us next. You're watching Bloomberg Surveillance. Good morning. Welcome to Bloomberg Surveillance. I'm Annmarie Hordern. We are counting down till 8:30 a.m. We are going to get inflation data in the United States. Really important given the fact that this is going to incorporate what we've seen in higher energy prices when it comes to the conflict in the Middle East. Equity markets pretty much just plowing along. When it comes to this ceasefire, they believe potentially this has legs. We've had 7 days of gains in S&P 500 futures this morning, relatively flat, but we're all in the green across the board. And then oil is where everyone's going to be focused on as we head into the weekend. Of course, J.D. Vance leading the U.S. delegation to Pakistan to meet with the Iranians. Brent crude this morning for the June contract $96, and WTI $90. Oh, just under $90. That's really important, Danny, for this White House to keep it below 100, and if they can, keep it below 90.
And it's really the backdrop for the talks this weekend and trying to get the Strait of Hormuz wide open. It's something that you would discuss with the president about Iran wanting to charge tolls. If this is what Iran is doing, even if it means reopening the strait to some degree, does there need to be a higher premium in oil prices just because of the ability of Iran to really control what's happening?
Also, there were no tolls before it. Of course, the U.S. Fifth Fleet was there and protecting it in a way, but it's going to be unacceptable not just to Washington, but to other Gulf partners like the UAE, Oman, Saudi Arabia, and that's the conversation we're having this morning. Under surveillance this morning, reopening Hormuz.
The market is highly skeptical that the ceasefire is real, it will take, and will actually open up the Strait of Hormuz. So until we start to see some sort of convergence between global energy prices against the Gulf Coast crudes, the message is that this ceasefire is just headline only, and it's all about the barrels and the flow. And right now, we're not seeing either of those two.
Here's the latest. Transit through the Strait of Hormuz remains limited despite President Trump's demands that Tehran reopen the waterway ahead of peace talks. Bob McNally of Rapidan Energy writing any increase in Hormuz flows would be slow and tentative, and Gulf producers will be reluctant to restart shut-in production until a durable deal is on the table. Bob joins us now. Bob, thank you so much. Your research over the course of this conflict has been really incredible. When it comes to this weekend's talks, how are you preparing clients about how to think of this, and what does success actually look like?
Thank you very much. So we're telling clients this: let's just step back and lower our expectations. All we know for sure is that President Trump called off, looked like to be a big attack on Tuesday night. And since then, the United States has stopped attacking Iran. That's it. Other than that, we're talking past each other on whether we're going to open Hormuz, under what conditions, and this and that. Saudi Arabia is still taking fire from Iran. Bahrain still taking fire. So the conflict goes on. As you've noted, the flows haven't resumed, and here we are. So going into the weekend, I think we should have low expectations. We'd put, there's maybe a 15, 20-ish% that they pull a real deal out of the hat. They have an agreement on restarting Hormuz, on the basic framework of a final deal, the nuclear, the missiles, the sanctions easing. There's a deal that's eventually going to be made. We don't sense that it's imminent, can't rule it out, but I would have low expectations about a realistic restart of Hormuz transit, which is what the market's waiting for.
Given the headlines, the oil prices are moving on the headlines, but the facts on the ground are that there hasn't been normal flow, and we're seeing just maybe a handful a day of vessels going through, and mostly they're Iranian or very friendly countries. Bob, is the futures market actually priced fairly?
Well, the futures market's very different than the dated Brent or the physical markets. They're two different things. It's in the futures market where we do see more expectations about where this is going. I think it is too optimistic. I think the sell-off was unwarranted, and I think it's going to likely reverse. I think futures markets are going to be converging upward toward expiry onto physical prices, which are reflecting that scarcity premium, and that scarcity is just going to broaden this month as that hole widens from Asia and arrives in Europe and eventually the United States. So, yeah, I think futures prices are going up. I think, when they look back at this, I think a real defining feature of this is the disbelief that this could even happen in the market. No one thought, but Rapidan, that a disruption in Hormuz could last more than a day or two. I challenge you to find anybody who said, yeah, it's going to take several weeks for them to clear up Hormuz. Now that we're in that nightmare scenario, folks want to believe it's going to end soon, and they accept pleasing words and verbal intervention about that. So there's been this willingness of the market. You see it in equities, you see it in bonds, you see it even in the crude futures. Tell me it's going to end soon. Eventually that's going to wear off, and we're going to have to deal with the reality of the biggest disruption in oil market history.
Bob, I think you're spot on. I think it says something about human nature, just our inability to hedge or imagine chaos and our desire for things to return to normal. So if oil prices do need to head higher, Goldman Sachs is talking about $100 a barrel, that being their baseline if this lasts months. Where do you land on where this energy market might settle, considering continued action in the Middle East and issues with the flow of energy?
So we have three scenarios for how the oil rally will end. The base case is a ceasefire, just not now. We're thinking maybe later this month, probably in the 120, 130, 140 era where now futures have converged up. So we probably have to go a little bit higher in physical. At that point, Iran's control over Hormuz will be degraded somewhat, and they'll decide time to make a deal. Now, if we have to take longer to have the U.S. military forcibly open the strait, and since we started late on that, later than I expected, that could mean oil prices 150, 160. That'll take a little longer, especially if we don't have international help. Finally, final scenario, this is our lowest probability, but you can't rule it out, is we have to do it the hard way. The rally ends because the oil price inflicts a recession and destroys GDP growth. And boy, that's an effective way to cap an oil price. It's the way we normally see oil price rallies end since World War II. There's a recession at the scene of the crime. And so that could be, you know, well north of 150. We find the new level that basically causes economic growth to slow markedly.
Some big fat tails in this. And one of the other risks, Bob, I had a conversation with Ed Morse now at Hartree, was at Citi and in various other places before, who in the beginning of this conflict said that one of the bigger risks for energy markets was the addition of Iranian proxies into the fight. And we have gotten that with Hezbollah, the risk being of what we saw yesterday, attack on a Saudi key east-west pipeline. Bob, beyond just what's happening through the Strait of Hormuz, how much are you monitoring the other energy infrastructure? And is it something that we're complacent on, the risks to those types of assets?
No, it's something we're very focused on, and Ed Morse is a great man. We are particularly focused on the one ray of hope. The one outlet here is that heroic Saudi decision decades ago to make that to build the east-west pipeline, and then to expand its capacity in short order from 5 to 7 million barrels a day and flow it through to Yanbu. And you see the boats there picking up. It's the one really offset we have to the loss of this 20 million barrels a day. It's terrific. It's not sufficient to offset the whole loss. It's terrific. Now you have the Houthis, and we've been saying this as well, are getting in the fight. And if they and the Saudis decide to hit those pumping stations along the east-west pipeline, which has already occurred, if they're able to hit the Yanbu terminals, that one last sort of ray of hope, goes away. And so we're very focused on if we escalate to the next level, and we would have gone there Tuesday night if we did a big attack, you will see the proxies come in, and we're most focused on the Houthis and the risk to that one Saudi redirect through east-west to Yanbu. Most important.
It's the pipeline the world knew it didn't need. Bob, thank you so much for your time this morning. Bob McNally of Rapidan Energy. Coming up on the program, another hour of Bloomberg Surveillance as we count you down to inflation data at 8:30. Abby Yoder of JPMorgan Private Bank, Erika Najarian of UBS, Matt Luzzetti of Duetsche Bank, and Jessica Noviskis of Marquette. You're watching Bloomberg Surveillance. Good morning.
This bull market has been battle tested.
The fundamentals have still remained very healthy.
Wall Street's figured it out. It's a buying opportunity. The market is highly skeptical that the ceasefire is real.
It feels like we're on the same kind of off-ramp here. That's pretty good for the market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
We're 30 minutes away from inflation data, live from New York City this morning. Good morning. I'm Annmarie Hordern. This is a third hour of Bloomberg Surveillance with Danny Berger. Lisa and John are off today. We, as I said, 30 minutes away from the CPI data. It's the first print, Danny, we're going to have that has the full impact of rising energy prices, rising oil prices due to what's going on in this conflict in Iran.
The expectation is for a 0.9% increase, and that would be the highest since 2022. Maybe the bad news for this economy is that you already had some concerning dynamics coming before that. We saw that in the February PCE. That was maybe a little bit stickier than we wanted. We heard from David Rosenberg writing in saying that the economy was already losing steam. To be fair, he is a tiny bit of a perma bear, but just concerned that even before the conflict broke out, there were these vibes in the economy that were not positive. This adds to it. So you see a market that is flat today. It's rallied a lot. I just wonder, does stickier inflation change the posture of those was willing to take risk.
And there's two big risks now going into the weekend. It doesn't really even feel like a weekend because there's not just the inflation data at 8:30, but then on top of that, everyone wants to see what is going to be the outcome of these talks in Islamabad. And individuals I'm talking to say the fact that they're just meeting, like, that's the outcome. That's the success of these talks.
Although Bob McNally from Rapidan was just on with us saying that he was saying to clients, set your expectations lower.
So low.
Yes, so low, and that we could have continued high oil prices. His expectation, we could see up to 150, or you go so far that there's significant demand destruction and there's a recession. We're not really talking about those odds right now.
Dr. Sultan, who runs ADNOC, which of course is the UAE's biggest energy company, said that the last vessels before this war that left the Strait of Hormuz, it's now over. They've landed at their destination, and there's no new inflow. And that is why this moment is so acute. And that's why the Treasury Department right now and the White House are weighing whether or not to extend waivers for Russian-sanctioned oil on some of these countries in Asia, like India, which are in town lobbying hard to try to make sure those flows continue.
Still just a Band-Aid on a very, very deep wound of a waterway. And again, I go back to what Bob said. I think he put it really well, that no one expected, maybe except for him, that Iran would be able to do this, that they'd be able to close the Strait of Hormuz. And here we are in the worst case scenario. And oil futures are still pricing that we fall below 80 by this time next year.
A lot of jawboning from this White House, but at some point, maybe the physical market, to Bob's point, will catch up. Where are we in terms of markets this morning as we head into that inflation data? S&P 500 futures are flat. We are off of a 7-day rally. Of course, investors are pretty much just baking in that this ceasefire for now holds. And all eyes, of course, as me and Danny have been talking about, will be on crude. New York crude this morning, $97.88. This White House certainly wants to keep it below the $100 mark. Coming up this morning, Abby Yoder of JPMorgan with stocks looking to build on their longest winning streak since October. Erika Najarian of UBS previewing next week's bank earnings, and Matt Luzzetti of Duetsche Bank breaking down the latest inflation data. We begin this hour with stocks flat and crude rising as traders await direction on the fragile ceasefire between the United States and Iran. Bloomberg's Tyler Kendall joins us now for Washington. Tyler, set the scene for us in Islamabad this weekend.
Yeah, hey, Annmarie, good morning. Well, we are expecting Vice President J.D. Vance to depart for Pakistan later this morning as the White House maintains that these diplomatic efforts are on track. Yet we did hear fresh threats from President Trump when it comes to the Strait of Hormuz overnight. In a pair of posts on Truth Social yesterday, the president said that Iran better not be charging tolls on ships that are transiting through the waterway and that Iran is doing a, quote, very poor job when it comes to reopening it. And this is important because, of course, reopening the strait is pivotal to the 2-week agreement, but it is underscoring the potential difficulties ahead for a longer-term agreement, considering that we know one of Iran's top demands is that they want sovereignty over the strait. Now, that is just one in what appears to be a long list of big differences between the two sides when it comes to negotiations, even as U.S. officials assert Iran is striking a different tone privately. It's the strait, but also the future of Iran's nuclear capabilities that appear to be the biggest disagreements at the moment. Now, while the U.S. and Iran will sit down in Pakistan, it is also important for us to note that there are going to be these parallel talks between Israel and Lebanon here in Washington next week after it appears that Israel's operation against the Iranian-backed militant group Hezbollah posed a potential roadblocks for the U.S. getting these talks this weekend off the ground. Annmarie, as you know, the White House maintains that Israel's operation in Lebanon is separate. It was never supposed to be part of these ceasefire talks. But after a reported call by President Trump to Israeli Prime Minister Benjamin Netanyahu, it appears that these direct talks have helped to pave the way for this weekend's conversation.
Tyler Kendall in Washington, thank you so much for your time this morning. Here's the view from Wall Street. Abby Yoder of JPMorgan Private Bank writing, quote, "We are still constructive on the market driven by fundamentals. We maintain our year-end S&P 500 bull base and bear targets, leaving us at 7,500 at the midpoint." Abby joins us now. Abby, good morning. Thanks for joining us. Can we get there if this ceasefire doesn't hold and it's not credible?
I mean, that's so when all of this started happening, we had to really think about it. Like, it's impossible to kind of figure out, like, pinpoint where it's going to go. But we wanted to do some scenario analysis around what would happen if oil prices as the main variable stayed at certain levels for an extended period of time, right? Because that's important. how long they're at a certain level is going to dictate like what this market does and what it means for sentiment. So no, if you have oil above $100 for the next 3 to 6 months, that's not going to get you to that, our current base case. But that's not our base case. Our base case is that oil reverts back down to an $80 per barrel, and it stays there for, for 3 to 6 months, right? And that's actually above that $80 is above what we had for oil previously. Our outlook was $60 to $70. So we are baking in that geopolitical premium.
Is this what clients are mostly sending you questions about right now? Is this top of mind?
Of course it's top of mind, but you go back to January and the biggest concerns were around software and what was happening from, an AI perspective and how, you have these private AI labs that are kind of overtaking the software space. And then there's also private credit that I still think is like going on underneath the surface, especially when you look at some of the financials performance. So I think even if we move past these geopolitical fears that are obviously front and center at the moment, those are still out there. And we've seen that kind of in price action in terms of the reaction post like ceasefire talks.
Software has been so interesting to me because it hasn't necessarily been logical. When this war first started, energy rallied and software rallied.
Yeah.
Now that we have a ceasefire, energy has fallen and software stocks have fallen 5%. This also from Bespoke, the 30 worst performing Russell 1000 names since the ceasefire began. 3 are energy stocks, 22 are software stocks. Abby, what do you make of that?
I mean, those are really good points in terms of it was interesting to see the bounce when the war started, but I think a lot of that was positioning related, right? Like you had gotten to valuations on broad software that we hadn't seen in 10 to 15 years, right? So there was an element of that. There was just a lot of, short positioning in that sense. But now, to your point, now that we have these ceasefire talks, you're seeing the broad market rally and they are not participating. And I think, again, that goes back to, okay, when let's say we move past geopolitical risk, what was at the forefront of everyone's concerns prior to that? It was really around software and what was happening from an AI perspective. Now, there are idiosyncratic moves in that you've seen cybersecurity names do really well, right? Like I think those stand out as probably the winners in terms of the application layer, but the other, software as a service general, is still under pressure from
unless whatever Anthropic, is putting out eats every single cybersecurity thing, which I guess is a threat now, as is all of human civilization. The other thing I found interesting, again, I was just looking kind of at broadly the market moves year to date, and small caps have actually outperformed a lot, 8.5 percentage points, which feels pretty significant just given the chronic underperformance. Is there something there that in this angst, maybe you get some of the smaller cap names that can play along?
Well, I think what you've seen, and small cap falls into this bucket, is what was working prior to the war. It was cyclicality, right? And so I think that's what you're seeing. You're seeing this rotation back into, okay, growth has actually held in pretty well. Earnings have held in pretty well throughout this, 6-week period. And so let's rotate back into what was working, that halo theme, the cyclicality, and small caps really do embed that and have been, a market underperformer for a very long period of time. So I think there's just room for positioning to increase there as well.
What has changed since the start of the year? Because there's been so many different narratives in terms of what you're recommending to sectors for clients.
Yeah, I mean, nothing has actually changed. I think what will be very pivotal, so we recommend 5 sectors: financials, utilities, tech, industrials, and healthcare. And I think, right now, if you look at the worst performing sector, it's financials, right? And I think this earnings season, which starts next week, and you're going to hear from Erika after this, really has anything changed? How does private credit really affect these banks? I think that's something that we're really looking at to really understand what we want to do in terms of a financials outlook. And then also, obviously M&A and IPOs have kind of taken a back step because of the geopolitical headlines. Is that still happening? Is that backlog still there? What gets that to start really working will be something that we're looking at.
When you look at earning revisions, it's for everything that's being hit right now with these headlines. Are you surprised by any of them?
No, I mean, to your point, so where have we seen? Well, first, let's take a step back. Typically, when you start the year, you see negative revisions for the S&P 500 to the tune of like 3% downward revisions. We've seen actually a positive revision of 2.5%. That's really interesting, right? And what's driving that, to your point, is technology primarily. We've seen 10.5% revisions for technology year to date. A lot of that concentrated in the semiconductors. And then you've seen it from energy and materials, just given what's going on with commodity prices. So it's a very interesting dynamic. It sets up, interestingly for 1Q again, which starts, next week. And the expectations are for 13% year-over-year growth, which would mark the 6th consecutive quarter of double-digit growth for this index.
I think that there's a lot of logic behind there between tech still doing well. Now you need to upgrade energy too. But what about for consumer-facing names, or frankly, any company that has plastics, needs to use fertilizer, is exposed to energy? Have those been factored into earnings outlooks yet, or does that need a bit of a wake-up call as we work our way through earnings season?
I don't think it's been factored in. I mean, I think it was interesting to hear from the airlines this week and that they really aren't changing their outlook. And in fact, they're actually increasing it by kind of tweaking things at the margin in terms of pricing. And so it's really going to be dependent. Like, I don't think that you can paint consumer as a whole in terms of because there's going to be differences in who has pricing power, right? Who can offset those input prices. But I do think it's going to be, not only do you have the commodity price impact that is very different than last year, but you also have the currency impact that will be different from a revenue perspective as well. So I think those two things will be very important in thinking about, okay, we've seen these positive revisions to earnings. The street is now expecting 16% growth for 2026 for earnings. How is that affected by these two major variables, I think will be very important.
Abby, thank you so much for your time this morning.
Thank you.
Thanks for stopping by. Abby Yoder of JPMorgan Private Bank. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief. The White House warning employees against insider trading, sending an internal email following a series of well-timed bets around President Trump's military decisions. In one instance, traders placed massive bets on falling oil prices minutes before the president announced a pause in attacks on Iranian infrastructure. The Senate Banking Committee is no longer planning to hold a confirmation hearing for Kevin Warsh next week. The hearing to confirm Warsh as the next Federal Reserve chair was scheduled for Thursday. Punchbowl's reporting Warsh has not submitted all of the necessary paperwork just yet. And in sports, Rory McIlroy is picking up where he left off at the Masters. After a sluggish start, the defending champion notched 5 birdies in 8 holes. He's tied for the lead at 5 under with American Sam Burns. The second round teeing off in just the last hour. I don't know enough about the Masters to say anything, but I do know, I have a feeling that this is why Jonathan had this week off.
Yeah, and that's what I'm also wondering, do you think he's watching the show or the Masters? It's
Masters. I didn't know they kicked off an hour ago. They start early.
I hope everyone has like Masters up next to Bloomberg Surveillance.
Okay. I've seen a few photos of that on financial Twitter. So yeah.
That's all you need on this Friday
morning. Lots
of
screens. Up next, the morning calls, plus Erika Najarian of UBS looking ahead to next week's bank earnings. You're joining Bloomberg Surveillance.
When CPI comes out today, everything will be swamped by the initial headline inflation shock from energy. The question, though, is 6 months from now, is that turning out to be a one and done or something more serious? I think it's more likely that inflation over the sort of medium to long haul is a bit more volatile rather than averaging a lot higher.
That was Krishna Guha of Evercore ISI. As we count you down to the inflation data this morning, markets are relatively flat. Of course, we have had 7 days of gains, and all eyes will be on oil going into the weekend. 97.82 right now on NYMEX crude as we await these high-level discussions between Tehran and Washington. Time now for the morning calls. First up, UBS downgrading ServiceNow to neutral and slashing its price target. The firm saying it's no longer better positioned for the AI era compared to other software names. Next up, Piper Sandler downgrading Nike, citing innovation concerns and worries that athleisure wear is, quote, becoming too saturated across the industry. I feel like that's an evergreen statement. And finally, Mizuho upgrading Shake Shack to outperform, saying the company has the drivers in place to exceed expectations throughout 2026. Let's turn to banks now. Goldman Sachs kicking off earnings on Monday. Joining us now is Herman Chan of Bloomberg Intelligence. Herman, thanks so much for joining us. So set the scene. What do we need to know for Goldman next week?
Yes, so we're expecting strong trading results across the board for Goldman and the banks that are kicking off earnings next week. So really good guidance over the past month or so from the likes of JPMorgan, Citi, and Bank of America on trading and investment banking on a year-over-year basis for the quarter. And lending's been pretty strong across the group as well, with the pickup in commercial lending in particular. So actually, despite all the macro issues on geopolitical front and issues on potential stagflation, we're actually expecting pretty strong earning results across the group.
What are you going to be most focused on? Is it just going to be the earnings call, how all these CEOs react to the whipsaw of markets and the headlines that are coming out because of the conflict in the Middle East?
Yeah, I think we're really focused more on the guidance for the rest of the year. How's the investment banking pipeline look? Has there been anything that maybe was taken out of the pipeline? Are we seeing a bit more choppier markets, particularly in IPOs and M&A? And also, can the lending that's been really strong to start the year, can that be sustained given all these uncertainties that are happening in the market today?
Herman Chan of Bloomberg Intelligence, thank you so much for setting the scene for us. Joining us now, Erika Najarian of UBS, and she writes our estimates for 26 and 27 are largely unchanged. Recent year-to-date performance could unearth some opportunities, especially given strong momentum in direct lending, capital markets, and deregulation. Erika joins us now. You've been very consistent when it comes to the banks. What are you looking forward to next week?
So I'm looking forward for some numbers, actually. We have been just dealing with a barrage of headlines, geopolitical, is AI going to wipe all of us out? Nobody's going to be able to, pay their credit card, or buy a fancy sweater. And so, I'm excited for the facts. And actually, the regulatory data is very promising. Direct lending to companies is up like 2.6 standard deviations above the seasonal average. The consumer, for now, crossing fingers and toes underneath his desk, still spending. And of course, capital markets is still booming. And so, the market is going to see this as largely a little bit backward looking. And so it's really important for us to hear from the management teams, especially the GSIBs, in terms of what they're seeing looking forward and how resilient these trends are.
The capital market strength has been pretty incredible. I remember having a conversation with Paul Taubman at the outbreak of the war, who basically said it's time to put the pom-poms away, that it might not be as robust. Instead, what we got was the best first quarter on record for M&A. I spoke to the heads of M&A at both Morgan Stanley and Goldman Sachs, who said it looks incredible, the pipeline looks good. Is there any reason to expect that will change in banks' outlook, that we won't continue to have strength, because we have, despite AI fears and war?
So I think we need to think about M&A and IPOs maybe a little bit separately, right? So it feels like in this current administration, there's like a very specific window for these strategic partnerships, right? Because you have you used to not be able to get like your handbag deal approved, right?
Oh yeah,
it's like monopoly on mid handbags.
Coach and Michael Kors.
Yes,
right?
yes.
Tapestry.
And so it feels like that window matters more than the volatility. Now the real question is that clearly there are blockbuster IPOs that are coming down the pipe, but what about the smaller ones? And now the sponsor saying, valuation has come in. And so what's more important, timing or waiting out the valuation once again? I think that's actually, could quite be more interesting to ask about, but it does feel like M&A, that boom will continue despite all these headlines.
The other headline that's been ever present is just anything related to private credit has attracted a lot of eyeballs. Will there be any spillover from the stress that we're seeing, again, whether it be stress just on the sentiment level or on the actual underlying asset itself?
So that's a great question, and I'm really excited for David Solomon and Jamie Dimon to kick this off because, I'm not going to use this opportunity to nerd out on the structure, but essentially...
By the way, you can. It's Bloomberg TV. If you're going to do it somewhere, this is the place.
So let me break it down to you like this. For the bank to lose the first dollar on these credits, you essentially have to lose, let's say, 40% equity first, right? And so the way they protected themselves in terms of essentially being very senior to the special purpose entity that holds the collateral or the pool of loans, and the way they've structured these credits, they essentially are, you have to burn through that equity first. And when you're hearing in the headlines that, banks are marking these loans, marking the value of the special purpose entity, they're actually behooving the fund to put in more equity, right? And so, I'm an equity gal, not a bond gal, but over collateralization is a technical thing, and that's the position that the banks are in. Now, Jamie sets the tone, right? And in the third quarter, he did talk about pests, yes. Right? And his chairman's letter sort of set the tone in terms of what he thinks, the defaults could be if we fall into recession. But the question for him is, okay, well, that's all well and good, but what is the actual blowback to the banks? I think that's the important question, because then we could put to bed, the underlying fear that there's a systemic issue here. And by the way, we're coming upon this sort of inflection point, these issues, where the banks are coming in with so much capital, so much liquidity, plus the regulators are redefining excess capital and liquidity. And the very definition of systemic risk is if the banks pull away, all that capacity away, and then you have a credit crunch. And I'm not sure that's the case right now.
One of the ways I've heard it described that it could theoretically be systemic is just that banks themselves lend to private credit players. And we've seen JPMorgan, for example, say, we're going to revalue what we think you're worth because of your software loans. Do you see a scenario where, one, there's spillover effects, or two, just simply that they decide to pull back from this area of lending because of those concerns?
Look, I think that there has certainly been a boom in these types of credits. But if you think about the brand name sponsors, right, they're going to be around forever, and they're your pipeline for a lot of other businesses other than, non-depository financial institution lending. And so you're not going to say, hey, I'm going to pull back from, Ares and KKR, right? And so, I think there's always going to be, a reevaluation of, credit underwriting whenever something like this comes up. But I'm not sure that there's going to be that big of a pullback.
If we could just finish on the banks for next week, what's your top pick?
Ooh, actually, I'm going to be a little bit spicy. So we upgraded Morgan Stanley.
An uncertain world by quality.
Well, look, Morgan,
your words.
If everything is on sale, buy the Hermes Kelly. Right? It's just funny to me that, in this capital markets renaissance, Morgan Stanley has been left out of the conversation, arguably one of the best investment banks in the world. And also, it's just a juggernaut in the wealth management business. And I think it's gotten hit a little bit on these AI concerns. But Morgan Stanley has proven in its history that it's not afraid to disrupt itself. Think about them buying E-Trade. So I think they're going to be, go in there and have a standout quarter and flex a little bit and remind everybody that, they're best in class.
TED pick flexing next week, maybe, according to Erika. Thank you so much for joining us, Erika Najarian of UBS. Coming up in the program, the latest round of CPI data is set to cross. Matt Luzzetti of Duetsche Bank will be here with us breaking it all down. You don't want to miss that data. Coming up in just 5 minutes' time, you're watching Bloomberg Surveillance. Good morning. Welcome to Bloomberg Surveillance. We are just moments away from CPI data in the United States. Of course, it's going to be an incredibly important inflation print because it's going to encompass the impact of the war in Iran right now and the rising energy prices. Ahead of that data, markets are just relatively flat. We just had 7 days of gains when it comes to the S&P 500. NYMEX crude this morning is down 0.3%. And with your inflation data, here is Michael McGhee. Hey, Mike.
Good morning. Well, we're seeing the war come home as CPI on a headline basis comes in up 0.9 for the month as forecast. And that pushes the year over year to 3.3%. Remember, it was 2.4% in February. So a big jump. The core comes in up 0.2 on the month. It takes a while for stuff to get into the core. So that's not a surprise, although it's a little lower than anticipated. The CPI core for the year, 2.6%. The index for energy, they say, rose 10.9%. Take a guess what gasoline went up, 21.2%. According to the Bureau of Labor Statistics, that accounts for 3/4 of the entire increase here. Index for food unchanged over the month. Food away from home rising just 0.2%. So it is not a bad overall report. Looks like it's driven generally by energy, but it certainly doesn't help the Fed's case at all.
No, it certainly does not. When you look at these March CPI energy prices rise 10.9% month over month. It's the most since 2005. And Danny, what we're seeing right now in the equity markets is a massive spike in S&P 5 futures as well as NASDAQ futures.
Yeah, we're seeing relief. We went from little change up to 0.2%. You also see bond yields come in too. They were all pushing higher. Now it's little change across the curve. The front end of the curve comes in 1.5 basis points. Annmarie, it's relief, but not massive relief, because we still have the big risk event this weekend. Yes, you have this in hand, but can you rush into risk right now? Even if CPI isn't as threatening, can you rush into risk with still negotiations to come over the weekend?
Right. This is a Friday, but really this is an extension of the week we're going to have. Tomorrow's all-important meeting is going to be the talks in Islamabad. And just moments ago, we had Vice President J.D. Vance climb up to his plane, and he is going to be heading over to Islamabad. So these talks will be taking place this week, but a lot of people say really just the base case is that they met. That might just be the success, which is why it's going to be interesting what it means for oil prices.
Yeah, and what do we see if these just get extended and we don't get a resolution? You and Mike were talking about the huge addition of gasoline into prices. Gasoline accounted for almost 3/4 of the U.S. CPI rise. Maybe that's something you can look through now, but how does that feed through to consumer behavior? Does that in turn impact what we're willing to spend? What's the bigger threat? Is it inflation? Is it growth?
Yeah, so gasoline, Mike, accounted for almost 3/4 of U.S. CPI, as Danny and you also mentioned. What else are you seeing in this report?
Well, I think one of the biggest things that everybody's been watching for is what happens with shelter prices, because we had been seeing a decline in house prices, but it looks like they've started to go back up again. Owner's equivalent rent up 0.3 and rent overall up 0.3 as shelter costs rise the same. So after a string of months where they were only rising 0.2%, they seem to be going up again. And that's not going to be good news for those looking for a long-term decline in core rates. So that is something to keep in mind as we go forward.
Mike, we already had data in hand from PCE of the prior month this week, which didn't exactly seem like a great starting point. What do you make of the 2 months together, not just this one in isolation? What do the trends look like?
Well, it's a little bit mountain-shaped. We went up in January, down in February, up in the month of March. And that's probably going to be the case, although we are likely to see another continued effect of the war in terms of energy in the April numbers. And then the question is, does it start to show up in things like food prices, because fertilizer has been unavailable and prices have gone way up? Does it start to show up in other areas where it just takes a while to get in there? And that's kind of the issue for overall for what we're going to be seeing going forward, is what kind of effects will the war have? And that is the job for the Fed, to try to separate that out and figure out what the underlying inflation rate is. A couple of other notes to pass on here is we see that new car prices were up only 0.1, and used car prices went down by 0.4. That's a surprise. Wholesale prices have been going up, so we had expected that to rise. Apparel prices look like they were up by a percentage point. So there's a tariff impact. Remember tariffs?
Yeah, we do. And we're still waiting to hear what's going on in terms of those refunds and potentially the new levels for other countries, Mike, after the Supreme Court, of course, struck down IEEPA. Michael McGhee, stay close. Thank you so much for your insight. Matt Luzzetti is joining us around the table now of Duetsche Bank. Matt, just what's your reaction for the CPI?
Yeah, I think as Mike highlighted, you want to kind of disentangle some of the stickier items from the volatile items. And I think for this print, it is important that rent and OER were stronger. That does tell you, they're a little bit higher than we expected. Maybe on a forward-looking basis, those things tend to be a little bit more persistent. Used car prices were actually materially weaker than I think we were anticipating. You had the decline that Mike had noted. I think over the next several months, those should be picking up, given what we see from wholesale prices. You did see airfares rose pretty strongly. Maybe that's reflecting a little bit of the rise in jet fuel prices as we look ahead. But overall, very strong headline print. Core print weaker than expected, but we'll have to see over the next several months. Probably get a pickup.
But this isn't the worst case scenario, is it?
No, I think for the Fed, you can look through a particular month, particularly driven by gas prices. I think more important for the Fed would be yesterday's print, which was core PCE. That is running at 3% year over year. It's a percentage point above their own target. Now they think that 50 to 75 basis points of that is from tariffs, but the starting point is just not good when you're overlaying another energy price shock on top of that.
So you have those two in hand. The market, Annmarie was just pointing this out to me, that you do have markets starting to price in more bets of a cut. We're something around 20% odds we get one by the end of this year. Given what you were just saying, is this a setup where you can get cuts?
So our baseline is that we will get a cut in the back half of the year. But kind of confidence in that has waned, I think. And the story and narrative to get there, I think, has changed. So coming into the year, we thought that we would see some meaningful disinflation over the back half of the year, core PCE falling below 2.5%. And with that, the Fed being able to cut rates, potentially as you get a more dovish reaction function under a Kevin Warsh-led Fed. We're not there yet, obviously. But I think that story has changed. Inflation is now too high. I think the probability that we get enough disinflation this year where the Fed cuts on an inflation story alone is less likely. And you likely need to see some weakness in the labor market to get the Fed to cut later this year. As we saw last Friday's jobs report, we don't see that weakness. You have a labor market that looks very resilient. The unemployment rate is actually declining a little bit. Payroll gains are picking up. And so I do think the market, yes, we're pricing a little bit of a cut, but the probability is pretty low at this point.
And this is where, and Lisa's talked about this a lot, where scenario analysis becomes kind of the only thing you can do, considering how big the left tail is. We were talking to Bob McNally, Rapidan, earlier, who's saying one of his scenarios, not his base case, but one scenario is where you get a huge hit to growth because of higher energy prices, and you need to start talking about recession. For you, what is the level where that can come into the picture?
Yeah, I think the way that we think about oil prices is there is this strong historical parallel between oil price shocks and recessions. I think 9 out of the 11 recessions that we had after World War II were coincided with a meaningful oil price shock. But the structure of the economy has changed materially over the past 10 years. We're now a net energy exporter, record production that we're seeing. Households still take a hit. But households are buffered given the tax cuts that we see. So the price level that we are kind of worried about would be about $150 per barrel for oil. That would eliminate the benefits that households have from the Trump tax cuts. We're not there. And obviously, we've moved away from those levels over the past week.
I just want to bring in Mike McGhee for another moment. I know he's been digging into the data. Mike, what else are you seeing?
Well, we've got some interesting surprises and some not so surprising news. You look at airline fares, they were up 2.7%. Of course, the airlines raising prices to keep up with the fuel problem that they have, but it's also the season where they start to raise prices going forward for summer vacations. But some areas did not rise, and that is a bit of a surprise. Medical care services were pretty much flat, down 0.2 on the month after a series of big increases. We also see motor vehicle insurance flat on the month. That had been going down. So some offsetting moves in things that actually will show up in the PCE when we get to that later in the month. But overall, kind of, as Matt said, expected in terms of inflation, and we get the usual volatility in various individual categories. The question is, how strong is underlying inflation going forward? That's the Fed's job to figure out.
Right. So there are some really negative pockets, but Mike is pointing, even Matt, to some decent improvement when it comes to inflation in some scenarios. I guess the Fed could breathe somewhat of a sigh of relief because they knew the gasoline shock was going to be there.
Yeah, you knew the gasoline shock was going to be there. You got some weakness in medical care commodities, used car prices. I think the one thing is, as you look ahead, the fact that rent and OER are stronger is important. Those are very persistent components. They're a much larger share of CPI than they are of PCE. But nonetheless, if those pick up, you build in a little bit more inflation as you look ahead. And then again, some of the weakness in used car prices, where we have pretty high confidence that over the next several months, those are going to bounce back given what we see from wholesale prices. The key question remains, how much pass-through do you have from this oil and energy price shock to core components? The Fed's modeling on that reaches different conclusions. The Fed staff's model suggests that you have very little pass-through to core inflation. They had some other modeling that they did after the 2022 oil price shock, which suggests that you could have more persistent pass-through. So I think that's the key question for the Fed.
I still just go back, and you're great on this, Matt, just the setup, that the setup wasn't great for this, that in PCE we saw this rise come before and the sticky inflation. If we couldn't get inflation down to target for the past 60 months, even before the outbreak of war and another energy shock, how do we even get there at this point?
Yeah, and I think that's the real issue for the Fed, right? Because even before this shock, the core PCE inflation was still a percentage point above their target. We are now, 5-6 years into the initial inflation shock that we saw after COVID. Yes, there are reasons why this time inflation is higher than it should be, and tariffs is the culprit at this point. But I think what you've seen is just more Fed officials growing kind of frustrated with the progress or lack of progress that they've seen on the inflation front. So even if you were to exclude another energy price shock and the fact that that could lift inflation on a forward-looking basis, you still are left with very little inflation progress over the past 18 months and a labor market that looks very close to the Fed's targets. In that environment, I think the Fed would be leaning towards keeping rates steady, and even in a normal environment could be thinking about that they are not restrictive enough to bring inflation down and the potential for rate hikes. Now, we don't think that that's a baseline, but I think it's a normal environment where growth is solid, the labor market is resilient and close to target, and inflation is a percentage point above target.
We just had the vice president depart for these talks in Islamabad. What are you looking forward to this weekend?
Yeah, I think the market has taken this view that both sides have just shown their hand and wanting to de-escalate, right? Now, the path between here and a full reopening of the Strait of Hormuz seems to be very unclear, and we've had very little progress on that front so far. But I think as long as the market sees continued progress or movements in that direction, then we will see oil prices that I think remain somewhat more subdued, the markets can remain more buoyant, and the markets will be a little bit less worried about Fed rate hikes. And speaking with clients, I think that they've really meaningfully taken down their view of the risk scenarios around this. I think they think that the peak market impact of this event is behind us. So there could be some complacency on that front. And so you do worry a little bit about that we have had these headlines. We believe that de-escalation is going to be in place, and that we're a little bit too complacent around escalation.
Right. The market is really holding on to the idea that this ceasefire can last.
Absolutely.
All right, Matt Luzzetti, thank you so much for joining us this morning. That was, of course, Matt Luzzetti of Duetsche Bank. Why don't you get to a recap and an update on stories we're watching this morning? Here's your Bloomberg brief. Recapping the data we just got. March CPI inflation rising 0.9%, the biggest monthly jump since 2022. Core CPI falling below expectations, suggesting that underlying inflation may be stabilizing at a lower pace. The data leading traders to price in one Fed rate cut later this year. And the 4 astronauts of NASA's Artemis II are on their way home. Their mission broke records, taking them further from Earth than any humans have ever been, as they got closer to the surface of the moon than any astronaut in more than half a century. Artemis II is expected to splash down in the Pacific Ocean at 8 p.m. Eastern tonight. And Taylor Swift and Travis Kelce have set a date and a location. They're getting married in New York City. The New York Post reporting the couple sent out save the dates for a July 3rd wedding. The power couple was reportedly set to marry in Rhode Island, but changed their plans to accommodate more guests. I guess congratulations are in order. I don't really care too much. I am wondering, though, where New York is going to be big enough that they couldn't do this in Rhode Island.
That was my thought, and this is just like kind of my selfishness of being like, I don't care about them, but it's also going to be happening at the same time as the World Cup. I'm kind of scared for us in New York City.
And America 250.
Yeah, you're right. It's going to be a scary, honestly, if you don't have to be in New York City, I would frankly leave for the month.
I'm going to send an email now and request that week off.
Good idea.
Next, Jessica Noviskis of Marquette Associates on the path ahead for interest rates. Plus, Bailey Lipschitz with your morning movers with CoreWeave shares rising after striking a deal with Anthropic. That stock is at more than 5%. You're watching Bloomberg Surveillance. Good morning. Good morning. Welcome to Bloomberg Surveillance. We're just off the heels of that CPI data coming in line. Important data, though, because, of course, this was going to give us a little bit of data and insight into the energy spike we saw following the Iran war. And what we see is that coming in line, so stocks like this, and stocks moved higher on the news. Of course, the S&P 500 has had 7 days of gain. So this Friday, we do look like we're moving into potentially another 8 consecutive session with the S&P 500 closing higher. We are just 1 hour away from the cash open. Let's bring you your morning movers with Bailey Lipschitz. Hey, Bailey.
Hey, we're keeping an eye on CoreWeave, the company striking a partnership with Anthropic. So now, according to the CEO, they will have Anthropic, OpenAI, Google, and Meta. So when you look at the reaction from analysts, there was a little bit of uncertainty since the company went public on over-reliance to a single customer. Well, they got the big 4 AI models right now in a partnership. So building on that, building on their ability to get access to NVIDIA chips. And as you can see, up 5%. This does come just a day after a big partnership with Meta was unveiled with a price tag on that. Want to position ourselves now with another company that's outperforming. That's Marvell Technology. This company was upgraded to overweight at Barclays. Closed at a 15-month high yesterday, already up more than 40% year to date, really benefiting from demand for AI data centers. According to the analysts, really pointing out the fact that there is no slowing in demand for building out those chips. And Marvell is kind of sitting at the crux of that, really saying that the company could rapidly grow and see its business rise by 90% this year and next. Want to talk about some of the underperformers or companies that are kind of down in the dumps, if you will, on the back of this AI momentum. Looking at software companies, DocuSign, Viva, and Autodesk, all down more than 1%. This does come after Citi cut half a dozen companies to neutral from buy. That analyst saying that most of these are good companies and well positioned for the long term, but outside of real catalysts for the next 12 months, you shouldn't be looking for a lot of upside beta. So maybe better to reposition elsewhere. So we are keeping an eye on the red on the screen. As you can see, software really the big losers these days with all the AI hardware and infrastructure companies on the upside, guys.
Thanks so much, Bailey. All right, the broader market, though, rising following the inflation data as traders add to bets on one Fed rate cut this year. Jessica Noviskis of Marquette Associates joins us now. All right, so Jessica, it was bang in line. So does this just basically mean the Fed can kind of look through what we've seen in terms of the energy shock?
That's exactly what we expect from the Fed. So the increase in the month-over-month headline number, March over February, was entirely attributable to gasoline prices. Gasoline makes up about 3% of the CPI index, and it was up 21%. So that's that differential there. Given the ceasefire, we think that is sort of cover for the Fed to look through this energy crisis and keep rates on hold when they meet later this month.
What about for investors, Jessica? Does it now mean we can look through inflation and look through to earnings?
I think investors are already doing that. I think this is more of the same that we've seen in markets, this persistent optimism, this buy the dip propensity. The markets and investors have been conditioned to look through volatility, to look through that worst case scenario, because that's what's worked in markets. If you've taken risk off at the wrong time, that's the best way to destroy value. So I think investors have been doing that, and they're going to continue doing that until they are confronted with something that they cannot do that any longer.
What's the borderline between that and complacency? Is it complacency in markets, or is there some real logic to this idea that markets are able to look through geopolitical angst and this specific energy shock?
It certainly depends on how long the war lasts. If this ceasefire holds and we see a resolution at the end of this, I think it's fair to write it off, depending on how quickly energy markets reprice. I think the other piece of this is that earnings have been strong. So even if you are a more fundamental manager, you can point to the fact that earnings are strong and earnings expectations are good. So that's sort of that backbone of markets. I think if we see, and again, Q1 earnings are sort of going to get a pass because of the timeline of the conflict, but I think guidance will be really telling. And depending on how earnings estimates trade out for the rest of the year, I think that could be sort of that difference between complacency and really reacting to fundamentals.
This is what I've heard a lot throughout the week. Everyone was talking about how they need to know the duration of this. This ceasefire, is this credible? Is it going to last longer? When will we actually see the Strait of Hormuz essentially open up? So the second quarter, Jessica, could we actually see revisions to the downside when it comes to earnings if these energy prices really start to hit?
I think we certainly could. I think this is an input for a lot of companies. We'll see how they price it in. This is similar to tariffs, where it was a price increase to companies. We saw little pass through. We're seeing more of it now. The consumer has remained resilient, so maybe there's more appetite to pass through and protect margins at this point. So I think there are still a lot of moving pieces. But we've heard that there has been, even if the strait opens, which it still hasn't, there has been structural damage to energy infrastructure in the Middle East. And to the extent that that keeps energy prices high, companies are going to have to factor that in.
Why is the market so willing to buy positive headlines and less so negative ones?
Because it's worked, it's been the right move. I think a lot of it has to do with the retail trade that we've seen really building in markets since COVID. We saw the quick bounce back. Russia, Ukraine was limited. Liberation Day, the bounce back. Venezuela was a quick win. I think it's what investors have come to expect. And I think the risk of missing out on U.S. equity returns for both U.S. investors and foreign investors is too high. So folks have chosen to remain invested, and I think we will continue to see more of that.
Jessica, thank you so much for your time this morning. Jessica Noviskis of Marquette Associates. We just had news this hour that Vice President J.D. Vance has boarded his plane. He's heading to Islamabad. This was just moments ago. This is, of course, ahead of tomorrow's U.S.-Iran peace talks. Vance telling reporters President Trump gave very clear guidelines for negotiations.
We're looking forward to the negotiation. I think it's going to be positive. We'll, of course, see, as the President of the United States said, if the Iranians are willing to negotiate in good faith, we're certainly willing to extend the open hand. If they're going to try to play us, then they're going to find that the negotiating team is not that receptive.
Bloomberg's Tyler Kendall joins us now with the latest. So, Tyler, we do have Vice President Vance heading over for these meetings. I keep asking this question. For the United States, what does success look like at these meetings?
Well, Annmarie, as you've mentioned on the program earlier today, it really appears just the fact that the negotiations are happening and getting off the ground is considered to be a success, at least at this moment, after we saw that potential roadblock yesterday over Israel's front in Lebanon. The thing is, there are just still such big differences between the two sides, as the vice president here is saying that President Trump has given them clear guidelines. President Trump has previously outlined that the U.S. wants to see no Iranian nuclear enrichment in a potential deal, and that the U.S. would be able to extract already enriched material. The thing is, we know that something like that is considered to be a non-starter from the Iranian side. Still, U.S. officials maintain that Iran privately is sending them a different message. But Annmarie, as you well know, another key part of this is the Strait of Hormuz, and publicly, Iran doesn't appear to be letting up on their leverage there. President Trump issuing fresh threats overnight, saying that Iran better not be charging tolls and that the country is doing a very poor job reopening the strait, as data is showing us that traffic at this point really hasn't resumed.
Yep, essentially still closed, and that's their entire leverage. Bloomberg's Tyler Kendall, thank you so much for joining us. Coming up on Monday, Peter Cheer of Academy Securities, Norman Rule of CSIS, and Henrietta Trace of Veda Partners. Jonathan and Lisa will be back with me on Monday. Danny, thank you so much for joining me, and you're taking us through at the 9 o'clock open.
Hopefully people aren't sick of me yet.
Yep, nope. big weekend ahead. I hope you enjoy your weekend as you, of course, stay close to your terminals. This is Bloomberg.